Good afternoon, everyone. Here we go. Now we can start. Mr. Nilo's here. Welcome to this informational hearing entitled The Evolution of Interchange Fees. I want to thank all of you for taking time from your busy schedules to come to the hearing, and especially to those who have invested the amount of time that it takes to prepare for the hearing. Let me make one agenda modification for those of you who track such things. On the third panel, actually the item number 3, the purpose of interchange fees, there's been a request that Mr. Rauschenberger testify before the other two panelists so that Mr. Rauschenberger can give an overview of how the process is intended to work. And so I think in the interest of clarity, we'll make that change to the agenda. This is an informational hearing, and so it isn't. Please don't concern yourselves with a lack of a quorum. There won't be any votes taken unless there is the expressed insistence of the members that we suspend all rules, and I don't expect that to happen. I want to thank those of you in the audience and the panelists for joining us today. Today, this committee is convening an informational hearing on the evolution of interchange fees. Due to the economic crisis, the nation has evolved into a cashless society, and there are other reasons for that as well, but I think that we would all agree that the issue of cash is one that is important into this migration into a cashless society. Plastic comes before cash or check out of necessity for many and for convenience. However, customers don't realize with every swipe of a credit or debit card, the merchant pays more. And in the end, it may be the consumer who also pays more. Now, interchange is a percentage of each transaction that is distributed among the merchant's financial institution, the financial institution that issued the card, and the card network that processes the transaction every time a credit or debit card is used. Currently, interchange fees are not regulated in the United States. This must be a topic of some interest because I'm trying to remember when the last time was I had standing room only at a banking informational hearing. Let me point out a few statistics regarding interchange fees. The value of interchange fees paid on Visa and MasterCard credit and debit cards was estimated to be $48 billion in 2008. The average American family pays more than $427 a year in interchange fees. With the price at the pump now more than $3 a gallon, credit card companies and their banks are collecting as much as 8 cents a gallon in interchange fees. Californians pay the most taxes on gas, more than any other state, at almost 64 cents per gallon. And this still doesn't include the interchange fees. Americans pay about $2 in interchange fees for every $100 they spend using credit or debit cards. Interchange fees range from 1.6% to 2.5%, depending on the card that is used. And Visa and MasterCard encompasses approximately 80% of the market. The federal government is currently looking at 3 different legislative proposals. 2 of them, Senate Bill 1212 and House Resolution 2695, would establish a process by which merchants and network providers could negotiate interchange fees and require the interchange fee be made publicly available. The last proposal is H.R. 2382, which would require network providers to remove constraints placed on merchants to accept all cards from a particular network, and would also require issuers to disclose network fees to credit card users. I'd like to point out that none of the proposed federal measures eliminates or caps interchange fees. The legislation merely opens the door for more information to become public and to provide merchants with more choices, where now they lack control other than the choice to not accept any credit or debit cards. I felt it was necessary to conduct this hearing to bring more attention to this matter and to determine whether or not California needs to take action. As you can see from the visual to my right, also included in the materials that you have been provided, the interchange fee seems to be quite complicated, but it is actually relatively simple. The visual shows the process of a credit or debit card transaction from start to finish. It shows the merchant receiving the biggest portion from the sale, but both the acquiring bank, which is the merchant's bank, and the issuing bank, which is the actual credit card bank, their actual credit card, receive a portion of the sale through the interchange fee. There are a few questions I would like addressed today and anticipate that we'll hear those through the testimony. Should interchange fees be regulated? And if they are regulated, will merchants pass the cost savings on to the consumers? While we may hear today that this is an industry versus industry issue, we need to expand this picture to include benefits to consumers. In this time of economic disarray, it is the consumers who are hurting above and beyond the financial industry and even the merchants. According to a study conducted by the Hispanic Institute, the current structure of the credit card system forces lower income and minority consumers to transfer hundreds of millions of dollars to higher income consumers. As a consumer, we have to ask ourselves, do we prefer more airline mileage, or would we rather pay less on goods and services? Low income and minority consumers should not subsidize the rewards for upper income customers. While I applaud the network providers for waiving interchange fees for charitable donations to help those in Haiti, I can't help but wonder why now and why only for that. Interchange fees have existed since the 1960s, and during this time span, the nation has endured dozens and dozens of natural disasters. I do hope, if nothing else occurs after today, that this act of kindness becomes more frequent among network providers. I would hope that all charitable contributions become exempt from the interchange fees. On that, let us begin with the first panel. Panel will discuss the overview of interchange fees. We have David Balto, who will give us an overview, Liz Gardner, who will update us on federal measures, and Alicia Puente Crackley, along with her colleague Cody Goebel, who will discuss the recent GAO report on interchange fees. If you could come forward. Don't be shy. Thanks. And let me indicate, as you're getting comfortable, David Balto is a senior fellow with the Center for American Progress and a former policy director of the Federal Trade Commission. Liz Garner is the Director of Government Relations for the Food Marketing Institute. Alicia Puente Crackley, the Director of Financial Markets and Community Investment, U.S. Government Accountability Office. And Cody Goebel, I'm sorry, they didn't give me any of your bio information.
So you're just going to have... Director.
Thank you. Assistant Director?
Yes.
Thank you very much. Mr. Balto, would you like to start?
Thank you very much, Chairman Nava. I appreciate the privilege of coming to testify before you today. As mentioned, I'm a senior fellow at the Center for American Progress, and for over 20 years I was an antitrust enforcer in the federal government. If I learned one lesson as an antitrust enforcer, was that for a market to function effectively, you need two things. You need choice and you need transparency. Only if consumers have both of those items can you expect that consumers will receive the benefit of a competitive marketplace. I think by any measure, the credit card market, especially from the perspective of the interchange, is a broken market. I have 5 simple points today. The first is you'll have people talk to you about the reasons for interchange. Interchange exists under a narrow exception to the antitrust laws. But it existed, you have to think back to years ago when people did paper transactions, and there was a significant float involved. There were significant transaction costs involved for the card issuing bank. They couldn't go and take on those costs by themselves. They needed to get something back from the merchants to help compensate them for those things. So think about it. Float, cost of processing. So, and that's why interchange fees were permitted. Now, what do we see going on over the past several years? Even though transaction costs have plummeted, we're no longer dealing with paper transactions. Interchange fees have skyrocketed. In the past 8 years, they've gone from $16 billion a year to $48 billion a year. Why? Because of a lack of transparency and choice. interchange fees in the United States are several times higher than foreign countries. Do you think that the processing costs in the United States are inferior to that of Italy? Do you think they're inferior to that of Australia, that our interchange fee should be substantially higher than these other countries? I don't think so. Second, the fact that these interchange fees are escalating so rapidly is a sign of a broken market. For them to increase threefold is a sign that there is market power being exercised, not that there is some great benefit. If we saw a competitive marketplace, we'd expect price to be competed down to marginal cost. Ask Mr. Bossi about it. Ask any of the dozens of merchants who have come in here to attend today's hearing. They live with price being competed down to marginal cost every moment of their working life. And because of that, they have to provide better services and cut their costs to provide things provide the best benefit for consumers. But when it comes to banks and their card issuing operations, they don't have to worry about price being competed down to marginal cost because they are members of two cartels, Visa and MasterCard. And Visa and MasterCard don't face the discipline of competition. You don't have to go through an elaborate antitrust analysis. The mere fact that interchange fees have tripled over the past few years is signs that this market is broken. Chairman Nava, you mentioned the gasoline example. If you go back to the period of escalating gasoline prices, the two entities that profited most from the escalation of gasoline prices were the foreign oil-producing nations and the banks, which could charge. Why? Because the banks that could charge an interchange fee. Why? Because they were both organized under cartels that could set whatever price they wanted. Third, as I've mentioned before, fees are higher in the United States than in other countries. Now, we're used to, when we go abroad, we sit there and go, thank goodness for an American competitive system. Thank goodness for all the alternatives we have. We know we're getting the benefit of the bargain. But if you could see your interchange fees when you went shopping, you'd be shocked when you go to Italy or Israel or Australia or in the EU. In the EU, it's only 0.3%. It's 2% here. So on a $100 transaction in the EU, it's 30 cents a transaction. Are we so inferior to the EU that we should be paying that much more than others? Now, the advocates for interchange fees will say, don't worry about the interchange fees. Consumers ultimately benefit from this. But let's get to the hard facts. We all know that some people receive benefits from reward programs. For every dollar of interchange fees, at most 44 cents goes to rewards programs. Only 44 cents. Now, let's compare cash customers to credit-paying customers. When I walk into the grocery store and spend $100, $2 goes to the bank in interchange fees. Maybe I get the benefit of 88 cents of that through some rewards program, maybe not. But the person who doesn't have a credit card, and 27% of the people in the United States don't have credit cards, that person, when they spend $100, they give that $2 tax to the card issuing bank, and they get zero benefits. Why should it be that affluent individuals who have rewards programs should fundamentally have money being transferred from poor individuals who can't afford credit cards? And why should they be going and subsidizing these rewards programs? That doesn't make sense. And again, it's 27% of the people in the United States. That's why the Hispanic Institute found in their study that Latinos and African Americans and other people who are underserved by banking services are fundamentally subsidizing these rewards programs. My final point, and this is the most important point, merchant sovereignty equals consumer sovereignty. In the audience today, you have 20 merchants who've taken time to leave their businesses. You have Mr. Bossi, who's taken time to go and leave his business to come and testify to you before you today. Now, the credit card associations will say to you, don't listen to them. They are just in it for the buck. and ultimately consumers won't benefit. Now listen, these people here, they exist on thin margins. If their costs go down, consumers are going to benefit. That's an everyday truism. They deal with very competitive markets. Now, the card associations, through their cartels, they don't deal in a competitive market. They can set interchange fees wherever they want. That's why they've tripled over the past few years. But when somebody wants to go and sell any other good to Mr. Bossy negotiates for the lowest price. If I'm a new ice cream sandwich vendor and I want to sell ice cream sandwiches in Mr. Bossy's store, he's going to say 25 cents isn't good enough. I want 15 cents. And ultimately, the consumer is going to receive the benefit of that. Mr. Bossy has that power in every other market except one, and that's credit cards. And that's where Visa and MasterCard say, take it or leave it. This is what you're going to have to pay. It's important to empower the merchants in the room today, to give them the chance to say yes or no, to give them the chance to exercise choice, to give them the ability to send information to consumers to make the credit card markets work. Thank you, and I look forward to your questions.
Thank you, Mr. Balto. Before I move to the next part of the testimony, you mentioned that in the EU it's 0.3%, in the United States it's about 2% on interchange fees. How does the USA compare with other foreign countries, and what do you believe the rationale for the difference?
The United States is the highest of all countries except, I believe, one country. And I think the reason for it is because the credit card associations know they can charge whatever they want, and they charge whatever they want. And that's why it's much higher in the United States than it is in other countries.
Do you have any information that with the European countries that charge a lower rate that they somehow suffer from inefficiencies?
I don't think so. And the experience so far in Australia, a country that has significantly reduced its interchange fees to only 0.55%, is that the market actually becomes more efficient. You know, the race goes to the swiftest. And if you tell somebody they actually have to run to succeed, they become faster runners. And in Australia, because the subsidy of interchange is gone, the card issuing banks have become much more efficient and have lowered their costs.
Thank you. Yeah. Mr. Nilo.
Just a couple points of clarification. The increase in interchange fees, you cited it, $16 billion to $48 billion, I think you said, in the aggregate. Is that right?
That's correct.
What period of time was that?
It's from 2001 to about now.
So that's an 8-year. Can you compare that to the valuation of the transactions that are covered so we could get a more accurate percentage increase?
We certainly could do that. We also...
Do you have that now?
No, I don't, but I'd be glad to get back to you about it. The history is, over the past 8 years, that the card associations, almost in lockstep, have increased their interchange fees on a regular basis, and we could also give you an approximation of that. One thing that's hard to do here, because the credit card associations are not very public about information, is actually gathering some of the information about all the fee increases.
And I get that. I just would suggest that the more relevant figure would be the relative figure.
I don't disagree with you.
I wish you had it here then if you don't disagree. The other question I'd have is, in other countries you cite the variance in interchange fees. Interchange isn't the only costs that are associated with the processing and use of credit cards. There's also annual fees charged on cards, particularly those of an affinity nature as well as rewards cards. And there's the interest rates that's charged on overdue balances and the like. How do we compare with other countries on the other factors besides interchange?
That's a subject that I would be glad to do further research on. One point, though, in Australia, once they reduced interchange fees, some of those other fees, especially interest rates, fell.
They did, and rewards cards pretty much either went away or the rewards were substantially modified as a result. And I'm not suggesting that's a good or a bad thing. The marketplace ought to decide that. But I realize that everybody is here with a particular point of view. When I saw the agenda overview of interchange fees, I thought we were going to get an objective report of an overview of interchange fees. This is not a criticism. You obviously have a position on this, and I'm not criticizing you. I am criticizing the agenda because it implies to me it was going to be an impartial overview. So I get it. This is going to be an advocacy, and I don't know if all three are going to be on the same side of this issue as you. But regardless of the side, I hope that within the advocacy that you bring to the table, that you provide a full analysis of the issue and support for your particular position. If you're going to come with one piece of information to provide as an example of a criticism, I really think you ought to bring the other pieces of information to balance it and still support your viewpoint. I get it, but Mark Twain once said, first get your facts straight and then distort them any way you please. We do that here all the time, but it's usually from this side of the dais when we argue things. And it is with regard to presenters when presenters are also biased. So I get how this agenda goes together. I think it's important to realize that, and I just hope we get as balanced testimony as possible.
Thank you, Mr. Neal. I do think that for whatever reasons, I somehow fail to believe that the industry is going to be lacking in their ability to articulate their positions and the decisions that they made and the rationales that they used. Mr. Ruskin?
Am I correct? In addition to, you mentioned, Mr. Neal mentioned interest and annual fees, but in addition to the interchange fees, there also, as a matter of course, two other fees that are paid. One is a process fee. There's another fee.
Sure. And by the way, these are instructive. There's a switch fee, a very small fee that Visa charges for and MasterCard charge for their back office operations. There are fees that the merchant processor, the person who puts the machine in the merchants, charges. That market is very competitive. There are dozens and dozens of merchant processors. And as a comparison, those fees have really plummeted over the last 8 years while interchange fees have increased.
Right. And then one thing that I didn't understand, if you could clarify it for me, perhaps I didn't understand what you were saying. You seem to be making the point that non-card holders somehow paid interchange fees. I don't understand.
So the fees that are paid, we don't, first of all, Visa and MasterCard do not, and this is an important point to emphasize, they do not permit Mr. Bossy and the other dozens of merchants or any merchant to sort of say, you want to use your credit card, this is what you pay. You want to use your, you want to pay with cash, this is what you pay. Yeah. And so
I think I get what you're saying.
And your point of view is that it's just like any other cost, like rent or anything else. It's something that basically everybody's picking.
What you're saying is that when a merchant sets a price, let's say $100 for a bicycle, he or she is setting that price to accommodate the use of a credit card, whether or not someone pays with cash. Is that what, and
yes.
so
and
that's
you
your
should
point.
go and ask the merchants about that in more detail. They can give you.
Mr. Fong and then Ms. Torres.
Yes, you mentioned in Australia they reduced the interchange fee down to 0.55%. Now, how much of that went to the consumers, passed on to the consumers, the savings?
I mean, first of all, it's important to realize that in Australia, retail markets are more concentrated and less competitive than in the United States. But I believe that the studies that have been done so far, though they're not definitive, suggest that consumers ultimately have benefited from that in terms of lower costs.
1%, 0.5%, whatever.
I could get back to you with specifics of what the Australian studies have shown.
I think Ms. Garner has some information.
Preliminary conclusions from the Reserve Bank of Australia estimated savings at 1.1 billion Australian dollars. That while it's difficult to measure a direct pass-through in prices, they anticipate that those savings would be passed along to consumers, and that's from their preliminary conclusions and their review of the Australia payment system reforms.
Now, if it's not passed on to the consumers, the retailers, the merchants would keep that amount. Was that not correct?
Retail is a super competitive industry, so I think that prices essentially would be lowered. You could look at, corner gas stations. If one gas station lowers prices, the one across the corner is going to have to as well. Additionally, additional savings from any type of reduction in fees certain businesses can have to reinvest in their business, be it through better health care to their employees or hiring more employees if they're a service-based organization.
Okay, thank you.
Ms. Torres?
Just from a consumer's point of view, I want some clarification. There are businesses that do not accept a credit card. There are numerous gas stations that do not accept credit card. And what you said about not the consumer being, I'm buying a product, that we don't have choices where to shop, or that we don't have choices about paying cash versus credit card. My experience has been the opposite. I buy from antiques from, very, very small business, and I am given that choice. If I want to pay credit card, it's this price. If I want to pay a check or cash, it's this price. So are you saying that the better equipped person to negotiate these fees, because the banks are going to charge the fee regardless, so are you saying that the better equipped person to negotiate this fee is the consumer buying the product or the business owner providing the service to the consumer?
There are a couple points. First, and I'm sorry, I'm an former antitrust enforcer, and if I get geeky, you can stick me on a plane to Washington right away. First, we want, from a competitive perspective, we want prices to be transparent. We want consumers to have choices. When a bank goes and charges me maybe an annual fee or something more clearly to say, that's clear. You can see it, obviously, and if you don't like the fee, you just sort of walk away and you go to another bank that doesn't charge the fee. The problem with interchange fees is that it's not visible. You don't see it. If you could make it visible, then people would say, wait a second, I'm not going to pull that card out. I like my merchant. I don't want him paying that extra fee, and I know it's going to cost me something.
As a consumer, I have that choice.
Well, increasingly, first of all, I'm sorry again to be geeky. So if the choice was significant enough, then they couldn't enter. If people turning to cash or checks was significant enough, then Visa and MasterCard couldn't increase their interchange fees. The market would be so competitive, they could not increase their fees. The fact they've been able to increase their fees shows that cash and checks really aren't a competitive discipline on Visa and MasterCard. I know that, and the reality is that we're becoming a cashless society very fast, and the percentage of transactions that are plastic is just skyrocketing, and so,
All right. Let me have.
I need to make another point.
Okay.
For me, crime prevention is not having $60 to fuel my gas in my pocket, so I choose to pay credit card. I go to fill my car to places where they accept my credit card, not to cash places. So that's a consumer choice that I have.
Thank you. Ms. Garner?
Mr. Chairman and members of the Banking and Finance Committee, good afternoon. Thank you for holding this hearing and for allowing me to testify today on existing federal legislation to address increasing interchange swipe fees. My name is Liz Garner, and I'm a Director of Government Relations at the Food Marketing Institute. The Food Marketing Institute represents 1,500 food, retail, and wholesale member companies in the United States and around the world. FMI's retail membership is composed of large multi-store chains, regional firms, and independent supermarkets. FMI also chairs the legislative subcommittee of the Merchants Payments Coalition, a group of retailers collectively representing about 2.7 million stores with approximately 50 million employees, who are working for a more competitive and transparent card system that works better for consumers and merchants alike. An average interchange fee of roughly 2% is collected by card companies and their banks on every credit card transaction and debit card transaction as well, and the rates can be raised at any time and by any amount. The supermarket industry operates on a profit margin of just over 1%, so these fees often exceed the profit margins of local grocers, making it very difficult for them to keep prices low for their customers, your constituents. Visa and MasterCard card issuing banks all charge the same set of fees, so there's no ability to negotiate interchange swipe fees. And because the over 35,000 grocery stores we have represent no ability to negotiate, or that we represent have no ability to negotiate or lower rates, which the Government Accountability Office recently confirmed are increasing, especially for premium rewards cards that have higher interchange rates, we are strong supporters of interchange fee reform. Currently, 3 pieces of legislation have been introduced in the United States Congress that are designed to address how interchange swipe fees are set and maintained. None of these solutions would set rates, but rather they would create an open and transparent process for businesses to negotiate rates, make their own business decisions, and enhance public knowledge and awareness of interchange fees that continue to increase, and the costs associated with those fees continue to increase to all consumers. The Credit Card Fair Fee Act was introduced in the previous Congress and was reintroduced in 2009 in the House of Representatives by Judiciary Committee Chairman John Conyers, a Democrat from Michigan, and Representative Bill Schuster, a Republican from Pennsylvania. Companion legislation was introduced in the Senate by Majority Whip Richard Durbin from Illinois. The Credit Card Fair Fee Act of 2009 is designed to provide fairness and transparency in the setting of credit card interchange fees and terms. The goal of this legislation is to incentivize the banks and companies that provide credit cards and the merchants that accept the cards as forms of payment to sit down together and work out a deal on fees and terms that both sides agree are fair. Card acceptance rates and terms are non-negotiable under the current system. In 2008, the Credit Card Fair Fee Act was favorably reported out of the United States House Judiciary Committee with a strong bipartisan vote. That bill and the current bill contains a clause allowing small banks and credit unions with less than $1 billion in assets to opt out of negotiations if they choose to do so. According to data from the FDIC that was published in American Banker last year, for financial institutions with less than $1 billion in assets, credit and debit cards make up less than 1% of their loan portfolios. Additionally, the GAO in their November 19th report on interchange fees found that in the United States, 88% of cards are issued by only 10 banks. Also, around half of credit unions offer credit cards, and credit cards make up 5% of credit union lending. Card networks also impose contractual restrictions on merchants that are unlike other business contracts, and that the card companies can change the terms at any time without any direct notice from the card companies to the merchant. These contract rules require merchants to accept all cards in the network, no matter how high the card's interchange fee, and they prevent merchants from encouraging a customer to use a card that might have a lower fee. These rules also restrict businesses from requiring a minimum amount on a credit card purchase. The New York Times reported earlier this month that these rules and lack of competition are leading to higher prices for debit card transactions that should not be treated much different from checks since they directly debit a cardholder's bank account. The Credit Card Interchange Fees Act, which was introduced in the previous Congress and reintroduced this year by Representative Peter Welsh, a Democrat from Vermont, and Representative Bill Schuster, would amend the Truth in Lending Act to prohibit certain contractual restrictions imposed on merchants. The Credit Card Interchange Fees Act also calls for greater transparency and disclosure of interchange rates and card acceptance terms. The Visa and MasterCard operating rules are hundreds of pages long, and that's without the card company chargeback guides. A chargeback being when the bank and card companies can charge a merchant back for a transaction. In conclusion, the legislation pending before Congress is designed to level the playing field between Visa and MasterCard and merchants. House Judiciary Committee Chairman John Conyers noted in a May 2008 hearing that members on both sides of the aisle seemed equally concerned about these fees and the effects they ultimately have on consumers. With rules still in place and fees remaining hidden, there is nothing to stop rates from increasing and raising prices to consumers, all consumers, regardless of what form of payment they use. I would again like to thank Chairman Nava for holding this important hearing and for the opportunity to testify today on existing federal legislation to reform interchange swipe fees. I'm happy to answer any questions.
Yeah, I just have a question. Do you have any sense of where Congress is with respect to these measures?
Well, as I noted in my testimony, GAO found that the top 10 banks control about 88% of this market. So they're the ones who are benefiting the most from interchange fees in the current environment. And given the atmosphere in Washington, I think anything that's really a Wall Street bank issue is something that could move.
Okay, thank you. If we could hear from Ms. Alicia Puente Cackley.
Should we switch? Sure. Do you want me to switch so I can read?
Sure, if you'd like. Yeah, that'd be fine. Thank you.
Good afternoon. Mr. Chairman and members of the committee, I am pleased to be here today to discuss issues relating to credit card interchange fees. Interchange fees represent a portion of the fees merchants pay to accept credit cards. Each time a consumer uses a credit card to make a purchase, the merchant does not receive the full purchase amount because a certain portion of the sale is deducted and distributed among the merchant's financial institution, the financial institution that issued the card, and the card network that processes the transaction. The majority of this amount generally is called the interchange fee and goes to the financial institution that issued the card. The Credit Card Accountability, Responsibility, and Disclosure Act of 2009, commonly called the CARD Act, directed GAO to conduct a study of credit card interchange fees. I'm here today, at your request, to discuss findings from our November 19, 2009 report, which covered a number of issues. First, the changes in the fees merchants pay for accepting credit cards and the factors affecting the competitiveness of the credit card market. Second, the effect credit card competition has on consumers. Third, the benefits and costs to merchants of accepting credit cards and their ability to negotiate those costs. And fourth, the potential impact of various options intended to lower merchant card fee costs proposed in the United States and other countries. In summary, total costs of accepting credit and debit cards for merchants have risen over time as consumers use cards more. Part of these increased costs may be the result of how Visa and MasterCard competed to attract and retain card issuers by increasing the number of categories and the rates for interchange fees. According to our analysis, in 1991, Visa and MasterCard each had 4 standard domestic credit card interchange fee rate categories. By April 2009, Visa had 60 and MasterCard had 243 different rate categories that could be charged for credit card transactions.
No, wait a minute. In 91, there were 4 fee categories?
Yes.
By 2009, one of the cards had 60?
Yes, and the other had 243.
Okay. Thanks.
In addition to creating new rates, some of the original rates have also been rising. We found that from 1991 to 2009, 43% of the individual Visa rates and 45% of the MasterCard rates that had prevailed in 2009, that had prevailed in 1991 had increased since they were originally introduced. 43% of the individual Visa rates and 45% of the MasterCard rates that were in effect in 2009 had increased since they were originally introduced. So, for example, the rate that applied to MasterCard transactions made with a basic non-rewards card at a merchant that otherwise would not qualify for a special rate, it's called a Merit 3 base, it rose 22% from 1.3% in 1991 to 1.58% in April of 2009. And a similar rate for Visa, which is called the CPS/retail credit, increased from 1.25% to 1.54%, which is a 23% increase from 1995 to April 2009. Concerns remain over whether the level of these rates reflect market power, the ability of some card networks to raise prices without suffering competitive effects, or whether these fees reflect the costs that issuers incur to maintain credit card programs. Issuers, particularly smaller issuers such as community banks and credit unions, report relying on interchange fees as a significant source of revenue for their credit card operations, and analyses by banking regulators indicate such operations traditionally have been among the most profitable types of activities for large banks. Some consumers have benefited from competition in the credit card market, as cards often have had no annual fees, lower interest rates than they did years ago, and greater rewards. Benefits to cardholders vary depending on how they use their cards. For example, those with credit card debt accrue finance charges and may pay additional fees. However, consumers who do not use credit cards may be paying higher prices for goods and services as merchants pass on their increasing card acceptance costs to all of their customers. For merchants, the benefits of accepting credit cards may include increased sales and reduced labor costs. However, representatives from many of the large merchants with whom we spoke said that their increased payment costs outstripped any increased sales. These merchants also reported that their inability to refuse popular cards and network rules that prevent charging more for credit than for cash payments limited their ability to negotiate payment costs with the card networks.
Let me interrupt you there because I think that touches on Ms. Torres's point.
Right.
I mean, could you repeat what you just said?
Sure. Merchants reported to us that they're unable to refuse popular cards. Basically, if you won't accept credit cards, people will take their business elsewhere, just as you had stated. And then network rules that prevent charging more for credit than cash payments limit the ability of merchants to negotiate payment costs with the card networks.
Thank you.
Interchange fees are not federally regulated in the United States, but concerns about card costs have prompted federal investigations, private lawsuits, and authorities in more than 30 different countries to take or consider taking actions to address such fees and other card network practices. Proposals to reduce interchange fees in the United States and other countries include setting or limiting interchange fees, requiring their disclosure to consumers, prohibiting card networks from imposing rules on merchants that limit their ability to steer customers away from higher-cost cards, and granting antitrust waivers to allow merchants and issuers to voluntarily negotiate rates. Each of these options is designed to lower merchants' costs for card acceptance. For example, setting or capping interchange fees would limit the amount of interchange fees that market merchants would have to pay. Both the Reserve Bank of Australia and the European Commission have used this approach, and regulators in other countries have worked with Visa and MasterCard to voluntarily reduce their interchange rates. If interchange fees for merchants were lowered, merchants could pass on their savings through lower prices to consumers. However, the extent to which they might do so is unclear. If these measures were adopted here, merchants would benefit from lower interchange fees. Consumers could also benefit if merchants were to then reduce their prices, but identifying such savings would be difficult. By capping interchange fees, Australian authorities estimated that Australian consumers had received savings exceeding 1.1 billion Australian dollars from the period of March 2007 through February 2008. But officials acknowledged that providing conclusive evidence of these savings is difficult because so many factors affect price levels at any one time. Whether or not merchants pass on some of their savings, consumers also might face higher costs for using their cards if issuers raised other fees or interest rates to compensate for lost interchange fee income. Some representatives of smaller issuers, such as community banks and credit unions, told us that with less interchange fee income, they likely would not offer rewards cards and therefore would be unable to compete with the larger issuers in the market. Representatives of larger issuers told us that with less revenue from interchange fees, they would consider reducing the amount of credit they made available to their cardholders. However, Australian officials reported that since their reforms were instituted, the number of credit card accounts in Australia continued to increase, and smaller credit unions have remained in the credit card business, albeit with some of their operations outsourced. Each of these options for lowering card fee costs also presents challenges for implementation, such as determining the rate for setting fees, providing more information to consumers, or addressing the interests of both large and small issuers and merchants in bargaining efforts. Given the uncertainty over the outcomes of each of the options, the industry participants and academic experts we spoke with did not reach a general consensus about which option or options would provide the greatest benefit. Although each option has advantages and disadvantages and difficulties in implementation, removing the network's anti-steering rules and restricting interchange fees with a cap or other limit were the two options that appeared to receive the most support from the large and small merchants and merchant trade associations with whom we spoke. Removing the anti-steering rules appears to have various advantages, including providing merchants with the ability to send signals to cardholders about which cards increase merchant acceptance costs, which could improve merchants' leverage in negotiating their payment costs. A significant advantage of capping or limiting interchange fees would be that it would reduce interchange fee costs most directly. The experience in Australia indicates that this option does lower merchant costs, and Australian regulators and merchant representatives said that consumers have also benefited, arguing that merchants in competitive markets generally lower prices. The main challenges to implementing this option are determining the right level of reductions, such as capping interchange rates at a level below that of rewards cards, and tailoring the change to avoid unintended effects on other networks or on smaller issuers. Mr. Chairman, this concludes my prepared statement. I would be happy to respond to questions.
Thank you. Just a couple of clarifying questions. Sure. When you spoke about the proliferation of rates, mentioning one went up to 60-plus rates, the other, I think you said 240-something, were you talking about just different interchange fees depending on the market segment, or were you talking about rates of all sorts?
We're talking about interchange fee rates specifically.
So they would vary according to the category of a merchant, for example?
It could be the category of a merchant. It could be whether it's a rewards card or a basic card. I'm not sure how many other, those two possibilities at least.
And what was, did you have a bias one way or the other about this proliferation of rates? I don't mean a bias. But some thoughts about it?
Well, the increase in different kinds of rates makes it that much harder for the merchant to figure out for any given card that's presented what rate they're going to have to pay, which is there's the increase in categories increases the complexity from the merchant's point of view. And then also just the variation of rewards cards, that's where the highest fees are on the rewards cards. So I think the increase in categories has increased the amount too.
Just a small point. In the case the Justice Department brought against Visa and MasterCard, the federal court held that the fact that Visa and MasterCard engaged in this type of price discrimination is evidence that they have market power. They have the power to increase prices as well.
And then in regard to when you mentioned steerage, I want to make sure I understand exactly what you're saying. Obviously, it has to do with the ability of a merchant to use one card as opposed to another, or to
accept one card as opposed to another, or to tell a consumer if you use a card, it's one price, and if you use a different card, it would be another price.
And what prevents the steerage now? Is it law, or is it?
These are network rules that are written into the contracts that the merchant signs with their acquiring bank. And the experience that Ms. Torres has had is right. There are merchants out there that are doing different prices. Technically, they're violating those contracts very often. They're not allowed to charge different prices for credit or cash, unless, in many cases, they can present those prices on all the goods. For gas stations, for example, it's easy for them to have a sign that shows the different prices for cash and credit, so we all see that. But for a merchant with thousands of goods in their store, it's too difficult generally for them to put two prices on each.
Yeah, so don't name the business.
Oh, I wanted to name the business.
I don't think it's a good idea to name the business.
Costco. Costco only doesn't take Visa or MasterCard.
Right.
So
You're next.
I mean, merchants have the ability to not take a card completely, but I mean, that's
Right.
Costco as opposed to.
I mean, we looked at the Costco example as one where it's a merchant that has a fairly narrow market, niche. That they only compete with certain other large warehouse stores, and so they have greater opportunity because there's fewer of them to refuse to take those cards. Whereas, restaurants in a city or airlines, if they decided not to take credit cards, would be at a significant disadvantage to their competitors that do take those cards, because there's so many other opportunities for consumers to go to the next business that does take that card. So,
Mr. Mendoza.
That was leading into one of the questions I was going to ask. your large retailers like Costco are able to create these relationships with banks, whether it be with American Express in this case, if that's the only one they take. You're saying that you mentioned earlier that large retailers are pretty much have no choice but to accept the cards, and because they don't want to lose the business. But then large retailers have the option to also create their own credit card. For example, retailers like Best Buy, you could go there and they get excellent benefits by getting, or even Sears or whatever. I mean, everybody has the opportunity to do that, but some of them choose not to. Right? There's other issues behind that. And you keep mentioning obviously the struggle between the merchants and the credit cards, and obviously I don't know how much we could do here in the state. As a state, it's more of a federal issue, and it's being played out right now as we speak. And I don't know if it's too premature or not, but it's a great opportunity to hear the discussion and be a part of it. I'm just wondering that can you explain why you feel that large businesses, like you're saying, large merchants, can't create their own credit card, can't create their own relationships like Costco, or even create their own?
I mean, we did talk to several large merchants that either in the past had their own credit operations, they offered their own cards, or many of them continue to do that. And it can be fairly expensive for them to run those operations, do the credit checks, do the statements, all the things that are involved in running that business. As a result, banks that issue cards or Visa and MasterCard have a competitive disadvantage. They can have lower costs as a result, and can do those services for cheaper than perhaps an individual business would be able to offer its own credit card and run those operations. I mean, I think a lot of the points that we found in our research is, even if it is very expensive for a business to take on that, does that mean that it's fair that they would face, price increases from those who do it at a more efficient level? So that was sort of the issue that it seemed like.
Did that answer your question, Mr. Mendoza? Mr. Nilo?
Clarification of a few points, if I may. You mentioned that 40% of individual rates from 1991 to now have increased. What happened to the other 60? You said 44, 43, 45. What happened to the other 55 or so individual rates?
For example, for Visa, which saw 43% of their rates increased over that time period, 45% of their rates stayed the same, and 12% went down. Similarly, for MasterCard, 45% increased, 45% stayed the same, and 10% went down.
Did that result in, on a relative basis, relative to transaction amounts, that overall fees in the aggregate went up, down, stayed roughly the same?
We didn't present any averages in the report. We talked about some ranges that were charged. And then, of course, as Mr. Balto pointed out, the overall amount that's been charged for interchange fees has increased. Part of that increase, as we point out, is due just to the fact that people are using their credit cards more, so it's a volume-based increase. But part of it is from absolute level increases in some of the interchange rates.
And our markets, ever thus, they are very dynamic creatures. I think it's instructive to know what the overall trend is, and then you can look at where individual movements are taking place and whether that suggests some disproportionate power in the marketplace. So far, I haven't seen necessarily that evidence. In the Australia example, you mentioned that some operations were outsourced. What did you mean by that?
What was outsourced?
I'm not sure what specifically we were referring to. If that was us.
I'm sure it's in.
But yeah.
In Where's the box?
I mean, from our understanding, the Australian situation, after the regulator lowered the interchange rates that could be charged by about half, banks responded by raising annual fees or instituting those where they hadn't, lowering the amount of rewards, as you pointed out earlier. Interestingly enough, they also lowered interest rates on some of their cards because they saw that as a way to compete for people who are going to carry a balance and pay interest. That was a revenue source that maybe they hadn't been taking advantage of by having higher rates in the past. So it had various effects.
Yeah, I don't have the specifics
Yeah, I'm not
of
sure
which,
about that.
I don't know which operations were outsourced, but
Well, no, I mean, what do you mean by outsourced? Just that other businesses did it, or it was sourced to other countries, or was there any particular kind of outsourcing that?
we didn't ask them for those details.
But
we could find out.
they contracted out some services to
Some
save
services
money.
that they had previously done themselves.
Interesting
I don't know
that
the
they would do that
specifics.
merely with that as a motivation. I mean, if it's less expensive, it's less expensive. The last question, do all card networks prohibit the tiered pricing or steering, as you called it, or are there some that don't prohibit it?
The rules were something that we looked at in some detail, but not perhaps did a complete analysis of. And so I would encourage you to ask that question of the card representatives when they're here. In some cases, they may not have an explicit rule, but from what we learned, they have another rule that perhaps may be written like, don't disadvantage our cards relative to others. And that prevents certain things like surcharging or offering discounts for a particular type of card versus another.
Now, if those clauses were not in the network agreements, given truth in lending requirements, which do prohibit different prices for credit transactions versus non-credit transactions, and other federal pricing rules, of which there are those based upon the, forgetting the name of the author of the bill, I want to say Patterson, back in the 1950s or so, there was legislation that regulated how people could charge different prices for different class of customers, which generally was frowned upon, and there are rules that judge that. I don't know how well they're enforced, but the laws nonetheless exist. So if those requirements weren't in there, would there perhaps be some problems with regard to violations of truth in lending and other federal price discrimination laws?
I'm not sure about truth in lending restrictions. We did hear of certain states that have restrictions that are designed to prevent bait and switch tactics. You see a price on a good, you bring it to the register, you suddenly are charged a different price. That in some cases that can interfere with a merchant's ability to charge different prices for cash or credit. But those don't exist in all states. As far as the federal level ones, I'm not sure. Perhaps Mr. Balto would have some sense of.
You're referring to the Robinson-Patman Act? Yes. And I'm sorry, you're referring to the Robinson-Patman Act, and it does not apply to credit cards.
No, not credit cards per se, but it applies to the merchant's ability to charge different prices. Oh, I'm sorry. It applies to a merchant's ability to charge different prices to different classes of customers, depending upon how that's defined, which could be the possession of a credit card or not.
Right, and there's a cost-based justification in the statute, and the fact that the merchant's paying less because it's not paying the credit card interchange fee would be a basis for charging a different fee.
Okay, thanks.
Any further questions on this topic for this panel? Seeing none, let me express my gratitude to you. Thank you very much. Before I let you go, Ms. Cackley, what we're talking about and what we've seen are three measures at the federal level. And this informational hearing is to provide the members of this committee with some data that they didn't have and some exposure perhaps that we didn't have. But is there a role for the states as it relates to interchange fees? I mean, anyone on the panel, do you see some role for the states here?
States, Well, you go first. Okay, states have in the past regulated things. They have prohibited, in some instances, surcharges. If states have the ability to prohibit surcharges, they would have the ability to permit surcharges by regulating network rules that limit the ability of merchants to surcharge. So that's one example. Another example may just be giving merchants the power to provide greater information about what fees they have to pay.
Mm-hmm. Anyone else?
Do you want to go ahead? Basically, I was just going to say that I think it's likely that this will be dealt with at the federal level, and I'm not sure that there's something very specific that you can do at the state level at this point.
Thank you.
I would just add that the bottom line here is that these fees do remain hidden, and holding hearings such as this one to bring more information to light is a great first step for any state, and we appreciate you holding this hearing.
And we'll thank the members of the committee. Mr. Ruskin.
Thank you, Mr. Chair. There was one other question. In the conversations over the past several days, some retailers have suggested the option of negotiating such fees. You've talked only about the options, or my recollection is I did step out, but you talked about the options of capping them, et cetera. Do you care to comment in any way about the option of fee negotiations between, as it were, two groups in the marketplace?
We did look at or discuss that option in our report as well, and there's still the largest concern for that option is the difference between large and small merchants and large and small banks. Sort of who's at the table and who's looking out for whom, whether the small banks have enough power to be heard, and whether the small merchants have enough power to be heard in that kind of negotiation. So that's an implementation issue. It's not necessarily a reason not to do it.
Thank you, Mr. Ruskin. And thank you all. The next panel, we changed the order of presentation. You have Steve Rauschenberger, who's the president of Rauschenberger Partners Electronic Payment Coalition. We'll be joined by James Beckwith, president and CEO of Five Star Bank, Jeff York, chairman, California Credit Union League, and the CEO of Coast Hills Federal Credit Union.
How are you?
Won't you?
Oh, glad to be here. I'm a little disappointed in the weather. Came from Chicago expecting San Diego weather.
Well, I'm assuming somehow 3 morphed into 5. Well, why don't we go ahead and start with Steve Rauschenberger. Welcome.
Thank you, and thank you, Mr. Chairman, for giving us the opportunity to talk a little bit today about our view on the issues of interchange and the electronic payment network. I had asked the clerk to distribute a presentation. I'm not going to walk you through it. This is a presentation I gave to the National Conference of State Legislatures Financial Services Committee to kind of brief them on this issue. And I would just call to your attention probably page 2 about payment card history. It actually goes back to the 1940s. Diners Club was the first. The first interchange rates were between 8 and 12% of every transaction. The next page deals with how big the network is today and how effective. 25 million merchant locations in 150 countries, 10,000 instantaneous connections every second, seamlessly done, almost always accurate, with very few problems. And then the next couple pages get into some retail benefits. prior to being a principal of Rauschenberger Partners, I served 15 years in the Illinois General Assembly, and during part of that time and before, I was 20 years a retail merchant. So I ran a little small three-store furniture chain, had about 75 employees, did about $2.5 million a month. Credit card business, credit card processing was intimate to the business we did. So just a couple quick things that I would kind of share as an environmental thing beside the background for you. First of all, you need to understand, I think, that this is an all-voluntary system. Despite what you may have heard with other panels or what other people talk about. It's voluntary to the retailer, it's voluntary to the card holder, it's voluntary to the banking system. Every single transaction's voluntary. Nobody is compelled or forced into any of these transactions. It is intensely competitive. When I was in the furniture retail business, a week didn't go by that I didn't get 2 acquiring banks calling me, competing for my business, offering to change the merchant discount, offering to give me new terminals, offering to give me a different kind of processing. It's a very competitive business that continues to this day. The banks robustly compete for business, and that lowers merchant discounts, which is the amount that the merchant pays. The interchange fee is one component of that. So sometimes I think the advocates for the other position kind of confuse people. What's at stake here is the merchant discount. Those historically have been in a 40-year decline as a percentage of each transaction. When panels talk about the tripling of the cost of interchange or merchant discounts, they're not reminding you that there's been more than a tripling of the amount of transactions. The acquiring bank and the issuing bank share the cost of the network. They share the cost of the transaction. The issuing bank takes the credit risk and stands all of the risk of fraud, identity theft, and all those other things that go with those. And that, in part, is what it pays for. I would also make sure, I hope everybody thinks a little bit about interchange is just one part of the cost of any retailers or merchants cost of doing business. It would be bizarre for me to come before you and say that people who shop during the daylight are subsidizing customers who shop at night because the merchant turns his lights on at night. So somehow we ought to change the regulation so that daytime customers don't have to pay the same price that a nighttime customer does. The cost of managing cash is substantial. Change error. Today, merchants are forced to purchase roll coin from banks. I mean, there's costs in no matter what payment. There are services that offer to guarantee check collection so that a merchant doesn't stand the risk of a bad check. The fees for those range between 1.5% and 2.5% of the face amount of the check. So no matter how you take money in a store, whether you're a furniture store or any kind of retailer, there's a cost associated with the different forms of payment. You have change error with cash, you have employee loss with cash, you have the cost of roll coin, you have the cost of deposit with banks. There's all different kinds of things. So to kind of pull the credit card cost out and say somehow that it needs to be socialized because it's unfair just seems to me to beg credibility a little bit, credulity a little bit, and I just... and also keep in mind that all of these are negotiable. When the prior panel talked about MasterCard and Visa going from a small number of rates to a large number of rates, they didn't do that because they wanted to report more rates on their internet sites. They did that because that's what their customers asked them to do. It is aggressive negotiations by big stores, Marshalls, by Best Buy, by Costco, by Amico, by big retailers and small retailers negotiating for different rates is why MasterCard and Visa have both been forced to go from 3 or 4 simple interchange rates to rates that reflect different conditions. One panelist spoke last time about how torturous it was to be in the grocery business and live on a 1% margin, and that an interchange rate could be larger than the margin a retail grocery store might get. I would just point out to you that both MasterCard and Visa have negotiated a flat interchange fee for credit card transactions that I think is under 45 cents, regardless of how much is spent at the grocery store. So a $100 transaction does not cost 1.6% at all. In that case, it costs less than 0.5%. So different stores, different merchants negotiate with the payment networks. You need to know that there is no monopoly. I mean, I kind of was a little, I was jumping up not quite as hyper perhaps as a former antitrust regulator, but as a former legislator, I get a little hyped up too. There is no monopoly. There's no duopoly here. The credit card networks, MasterCard, Visa, and the banks have been looked at numerous times by states' attorney general, by the U.S. government, by the Federal Trade Commission, over and over and over again. It's a competitive marketplace. There are more than 20 payment networks. So besides MasterCard and Visa, there's 18 other robust competitive markets. The Diners Club and American Express people would be very offended if they knew in this room that they were being considered rounding error in the whole payment network. PayPal is an emerging one, which may be the iPhone of payment networks. There's not a credit card company, not a network in the world that's not worried about the fact that hundreds of millions of dollars are now being paid for Haitian relief through cellular telephones without using a payment network. So just as we have evolved, extraordinarily over the last 20 years and what the Internet can do, that's what's happening with our payment networks. That's why they're robust. I could go on, but let me leave you with the last thing, which I think is perhaps the most misleading. When people take out of context what goes on in other countries and say somehow it needs to apply here as a rule, I just hope you're very cautious in coming to those conclusions. All of the reporting done about the savings in Australia were from the same their Federal Reserve, their central bank that ordered the change. If you take a look in our packet we came up with, and we can provide you with a lot more information, the consumers and the media in Australia do not agree with the central bank, which is telling our GAO their own conclusions about their own regulatory decisions. You also need to know that the entire Australian economy is run with 8 banks. They don't have 15,000 robust banks competing in their system. It's a different system entirely. And when you isolate one part of the merchant discount, the interchange fee, and compare England to the United States without comparing the rest of the fees or the total cost of the system, it's just misleading people. The cost of credit in the United States is lower than almost every place else in the world. We have the most robust system. Cards are more widely held in the United States than any place else. They're more widely accepted. And the last thing, and I'll close, because I know it was like my hearings always ran long, because I always like to ask questions. But if you want to know whether this is a good issue or not, ask someone if they're satisfied with their credit card. You don't need to make a decision on whether they want a mileage plus card, or they want the card with 0 fees, or they want the card with 8% interest, or they want the card that allows them to buy a hat a month from a store. They make that decision. Ask a merchant. Go out of here, not the ones that are here, but go out when you're shopping over the weekend. Ask a merchant whether credit cards have improved their business or hurt them. And I can almost guarantee you 95% of them are going to tell you credit cards have been wonderful. They are negotiated. They are robust. It is competitive. I just hope, there are some large retailers that have been funding an almost a year-long effort to call into question this electronic payment network. I hope you'll give it some careful thought. We'll be happy to answer questions, and I'm sorry if I ran long. Thank you,
Not at all.
Chairman.
Not at all. Any questions from members of the panel? Mr. Nilo.
Well, first of all, I'm now getting clear on this. Overview of interchange fees means why interchange fees are a problem and must be regulated. And the purpose of interchange fees, I'm anticipating, is why interchange fees are a good thing and why they shouldn't be regulated. Two questions. You say that the market is not a monopoly or an oligopoly.
Or a duopoly, or any opoly you want. It's not.
Well, mono is 1, do is 2. I'll grant you that. But the statistics show that 10 banks dominate about 90% of the
card
transaction
issuing
value. That's not an oligopoly?
No, that's card issuing. It's not acquisition, which is the other part. The cost of issuing cards nationwide and complying with the federal and the 50 states disclosure means a lot of small banks can no longer be issuers. If we want more people issuing cards in the United States, we need to kind of take a look at, we all get that little Bible they send us when you get a credit card. You know how many lawyers so small bank chains in Illinois and other states no longer issue because of the exposure they have under the regulatory scheme. So it isn't maybe as robust as we'd like, but it's more robust than most places in the world.
second question and last. You talk about the cost of handling cash compared to the cost of handling a credit card. Are you suggesting that the cost of handling cash, avoiding that cost, offsets the cost of handling the credit card?
If you want to do an analysis on a transactional basis like some members of the previous panel did, you have to take a look at not just the cost of what it costs to accept the credit card, but what are the costs of the alternative forms of payment. When I was in the furniture business, it was expensive and problematic for us to handle large cash transactions. We didn't want to take an $8,000 truck COD at the door. We also were very nervous about large checks, particularly for transactions where people were taking the products with. So there are costs associated with any choice in the transaction, whether you make them bring gold dust into your store or whether you take American dollars or checks. What I guess I'm suggesting that they ought to be compared, not dealt with in isolation. And in our business, and I haven't been in it for the last 12 years, but in our business, we always thought the cost of managing checks and the attendant problems was higher than the discount rate we had to deal with credit cards.
Any further questions? Thank you very much. Next, we hear from James Beckwith.
If I could introduce Mr. Beckwith. Mr. Chair, members of the committee, on behalf of the California Bankers Association and the California Independent Bankers, I would like to introduce Mr. James Beckwith. Mr. Beckwith is the President and Chief Executive Officer of Five Star Bank and its holding company, Five Star Bancorp. He came to Five Star Bank in 2003 with over 20 years of banking experience. Prior to joining the Five Star Bank, Mr. Beckwith served as Chief Financial Officer and Chief Operating Officer of National Bank of the Redwoods in Santa Rosa. He is a graduate of San Francisco State University, and where he earned a Bachelor of Science degree in Business Administration with a concentration in accounting. He's also a graduate of the Pacific Coast Banking School at the University of Washington. Mr. Beckwith is here today to provide testimony on the benefits of interchange fees from a community bank perspective.
Mr. Rauschenberg, I'm sorry, we don't have anybody to introduce you.
Well, retread legislators don't get introductions.
If he wants a bill from the association, I'm more than willing to do that on his behalf.
Thank you very much. Mr. Beckwith.
This is the first time I've testified in front of a committee, so thank you, Alex. I didn't know I was so important.
But you're certainly welcome here.
Thank you. Good afternoon, Mr. Chairman Nava and members of the committee. I'm James Beckwith, the president of Five Star Bank, which is a community bank in Sacramento. We've got 3 offices in Sacramento and 1 up in Redding. In 1999, a group of Sacramento area business people whose goal was to provide local banking with an emphasis on customer service to small business and commercial real estate investors. Today, Five Star Bank has grown into a trusted business partner, providing small business owners and professionals and real estate investors with solution-based personal service. We provide numerous business accounts with a variety of features. We service our small business clients by providing merchant acquiring services, which process credit and debit card transactions. We also enable the issuance of credit cards to meet our small business customers' credit needs. By providing credit and debit card transaction services to our business clients, they benefit by not having to extend credit directly to customers, having generated funds immediately after a customer transaction has been completed, reducing their exposure to bounced checks, reducing the amount of cash kept in the store, which could be susceptible to theft, and that is a significant cost. I want to emphasize that point. Access to a state-of-the-art fraud detection system, which smaller merchants do not have the resources or expertise to implement and maintain, and also being serviced by our highly trained staff. There are costs to provide this service to our business clients. We negotiate those fees with them, and there is an understanding that is a fee for service provided. I want to emphasize the point about negotiation of the fees. We start from the discount, what the discount rate is, and all of those negotiations are very competitive with other people in our marketplace. This fee is service is just fair as costs associated with processing checks, counting cash, and providing statements of account transactions. Interchange fee revenue is not a huge profit center for us. However, the value lies in the ability to offer credit and debit card acceptance to our business clients. Without the incentive and interchange fee revenue, our bank would be hard-pressed to compete against our larger competitors. Reductions in interchange fee revenue may result in less community banks offering credit and debit card services to their local business clients, and also a reduction in the number of people that we can afford to hire. In addition to the benefits our business clients have with credit debit card acceptance system, they also benefit from our credit and debit card products. Our business clients use these credit cards as lines of credit that provide them with short-term financing needs, including providing seasonal working capital, purchasing inventory, financing receivables, the ability to take advantage of trade discounts, managing cash flow, rewards programs, and grace periods. In conclusion, I strongly believe that the credit and debit card interchange system is working. It provides tremendous benefit to American consumers who are opting in greater numbers each day to use credit and debit cards. Merchants have many choices available to them with regards to the form of payments they wish to accept, such as consumers have many choices regarding the financial institutions which they can choose to do business. I compete every day for the business of both merchants and businesses and consumers, and I do large so thanks to the availability of interchange fees. Intervening in a functioning market will only harm merchants and consumers currently benefiting from this efficient process.
Thank you very much. Any questions? Mr. Ruskin.
Yeah, just so we can understand this a little more clearly, can you go into the difference between what service you expect that you receive for the interchange fee, what service you receive for the process fee, what service you receive from what one of the other witnesses called a switch fee, I think. There are those are the basic fees. And I know there's annual fees. I can, that stands for itself.
In terms of our community bank, in terms of the fees that we receive, we're an introducing sponsor, if you will, into the merchant acquiring environment. We receive a very small amount, usually 10 to 15 basis points for that activity, along with fees associated with setting up an account. Well, we could expand that fee amount if we take on more risk. And depending upon the merchant and their business activities, sometimes that expansion is warranted if we want to take on the customer. Usually this particular aspect, this merchant acquiring business, is a part of a greater relationship of which, unless we provide this, we have no chance to bank that particular customer. So we view it as a very necessary part of our business to make sure we offer this.
But what specifically do you feel you receive in exchange for the interchange fee? What specifically do you?
Oh, as a bank?
Yes.
I know that my customers' business transactions are going to be completed and their cash flow is going to be improved, which means either my loans get paid down more quickly or the deposits they maintain in my bank are larger. Did that answer your question?
I'm just trying to understand. We were told there's also process fees. So there's various kinds of fees that when a customer uses a credit card, in that transaction, the merchant is paying, I understand, a process fee, is paying another kind of fee, plus an interchange fee. I'm trying to understand what services the merchant is receiving, or the bank, well, in this case, let's say the merchant.
Okay. Yep. Thank you.
I'm sorry. Perhaps I wasn't asking it in a
clear
enough way. What services is the merchant receiving for each of the most common fees that are being charged, including the interchange fee?
Maybe I can help with that with the indulgence of the chairman. The interchange fee basically reimburses or incentivizes the issuing bank, the bank that mailed out, persuaded everybody who's got a card to get their card and pick their specific card and does the billing statements to you and promotes them with mileage points or whatever it is. The issuing card is the bank that issues the credit card, accepts the credit risk, manages your account. So the biggest piece of the merchant discount almost always goes to the issuing bank, because the issuing bank is accepting the credit risk. They're saying they're going to believe that because of the swipe, you're them. The next piece goes to the acquiring bank. That's the bank who is the bank of the merchant, who says, I'll help you set up the swipes, and I'll get you the terminals, and we'll as soon as it goes through, we'll put the money in your account. So the bank that acquires, or kind of is the front end of the transaction, gets the next biggest piece. And then the third piece that's consistent is the switch fee, which is the MasterCard or Visa network charges, which is very, very tiny compared to the other two, because basically it's just an electronic network. Now, that's different for a Discover or American Express, because they don't go through the banking system. They operate a proprietary system where they are all sides of the transaction. What I explained to you is the major issues for a Visa or a MasterCard transaction.
And when you think about an interchange fee, does that involve data security as well? The provision of data security.
The issuing bank is generally the one who's responsible for most of the fraud detection and fraud prevention, and when there is a loss of data, whether it's through a compromised retailer or someone breaks into your house, something as simple as a robbery all the way up to data mining, it's the issuing bank that stands all the cost of recalling whatever number of credit cards have to be reissued. Yes.
I'd like to make an additional point on that, and it gets back to the cost of providing the service, and this might be helpful for the committee. Fraud does occur in this space, and it's fairly significant. The acquiring banks are primarily at risk of it if they don't meet and don't follow certain guidelines. And that fraud can be significant depending on the type of business it is, and also just in stolen cards in general. And this fee, this discount, helps pay for the cost of that fraud, which is expanding. Now, I can't really speak to industry statistics about it. I only can speak about my bank. And every year we have, 5-digit figures of transactional fraud associated with credit cards and or debit cards. And there's nothing we can do about it. And it's very frustrating. And it's hard I don't even believe we're recouping our costs for providing that. I think at best it's a break even. So I wanted to make sure the committee understood that.
Thank you. Mr. Swanson.
Yeah, there seems to be a capital investment associated with being able to manage the fee. And so and it seems to be, in some cases, substantial, and then the unintended consequences. There are costs associated with that. So your position has something to do with if you have this integral system, then you don't want any participant in the system to disproportionately bear any unexpected costs.
And more than that, I guess I would just urge you, particularly as elected officials, the people that aren't here complaining are the customers. Those couple 100 million Americans that are managing their credit cards and their debit cards, are overwhelmingly happy with the system. They make decisions about which kind of card and when, and so if we're getting into an issue where we maybe are concerned about whether merchants and banks are wrestling well together on the mat, I guess I just would be cautious that we don't make the same mistake, or the U.S. or California or Illinois doesn't make the same mistake that Australia did. We're trying to go in using central bank regulation on a system that worked extraordinarily well, and then deal with the fallout, because it's the customers that are mad. I mean, the central bank in Australia is quite satisfied, just as Bernanke is. It may be the customers that are not satisfied with the decisions that the central bank made.
And I would just say to anyone else on the panel, I was just curious about the capital investment, that there's no way to avoid a capital investment to support the system, and so then the question becomes, is it reasonable to expect that there's some return on investment?
Mr. Ruskin, did I see?
Yeah, can you offer us some more? I'm interested in the consumer reaction in Australia?
Well, the consumer reaction based on the media reports, and there's a little bit in what we handed out, and we've got a website we could probably provide you with about 80 articles. The press and the cardholder response in Australia for the first 18 months has not been very positive. The fees for the credit cards went up. In other words, your annual fees went up almost across the board. Rewards went down. I mean, because these are all things that the banks and the issuing banks were using to compete for customers that customers were satisfied with. Because of this kind of big bank versus big retail discussion, the regulators in Australia made a decision to go in. And the problem with the regulatory decision is there's no way to make it perfectly. I mean, every one of our constituents makes a decision to buy a television set. They don't buy exactly the right TV, maybe from our point of view, but if they're satisfied, all of those decisions, the marketplace makes them. So the response in Australia has not been good from a public or from a press point of view.
Anyone else before we give Mr. York an opportunity? All right. Mr. York?
Mr. Chair and members, Melissa Emelexon with the California Credit Union League. I'd like to present to you our witness, Jeff York, who's chairman of the California Credit Union League for 2010 and CEO of Coast Hills Credit Union.
Thank you and welcome.
Thank you, Mr. Chairman and members. I appreciate the opportunity to speak before you. This is my first time here speaking, testifying, so I appreciate that. Let me just give you a quick briefing about Coast Hills Federal Credit Union. And by the way, I took the 7 a.m. flight out of Santa Barbara this morning, so I'm a little...
No, you hear him calling my name because I missed it.
Oh, is that right?
Yeah.
I think I was already on the plane.
I gave up my seat to make sure that you could be here.
All
That's a great chairman.
All 17
And he
of us
walked
appreciate
the whole way.
Coast Hills was formed in 1958 to serve the airmen and women of Vandenberg Air Force Base. Since then, we have expanded. In the late 80s, we expanded to a community charter credit union. We serve San Luis Obispo County and northern Santa Barbara counties. We have 65,000 members. We've got 11 branches to serve those members. We have 40,000 debit cards and 10,000 credit cards. We are not considered a big fish in the financial services marketplace. But in our area, the Lompoc, Santa Maria, San Luis Obispo area, we are a big fish in a small pond. Having said that, our vision is to make a difference in our neighbors' lives. We do that by protecting our members every day. We provide products and services that will help them better their lives. And we use our credit and debit cards as a relationship builder. I cannot say that they are profitable for us because they are marginal if at best. And they're priced that way. We are not for-profit financial cooperative. And that's our business model. But we use them as a relationship builder. Interchange helps offset the expenses that we incur with the credit card and debit card issuing, but it does not come close to offsetting the actual costs of administering those. Those expenses include fraud, which has been mentioned before, data breach, which is not our data breach, but merchants' data breach, which we have to pay for. And the California Credit Union League has done a great job in introducing regulation or legislation that would help with data breach, but in the past 2 years. We also deal with loan losses, the credit risk that's involved in credit card administration, and also the administration costs, plastic cards, mailing. We have phone and branch personnel that serve our members. And again, Interchange does not cover the costs of providing those services. We feel that the merchants, everything's been said already for the merchants, that it's a convenience, it's a cost of doing business. That's how we feel as in the credit union market space, that this is a cost of doing business. And much like shipping costs or utilities that they pay, the interchange and access to the payment card process is a cost of doing business. We also feel that the legislation that's in Washington, D.C. would drive out smaller financial institutions. We would not be at the table negotiating with large retailers. Therefore, we would be pushed out of the market space. We would also, we would be very likely not able to offer our product any longer, so we wouldn't be able to build those relationships if the interchange was reduced. And I believe that we provide a service to our members in providing choices to them to save money and better their lives. And I believe in the end this would increase costs to consumers because of that. They would pay higher rates, they would pay higher fees, and so on and so forth. I do want to mention one more time the data breach is becoming more and more prevalent. We're having to deal with that. There's no accountability, so to speak, on the there's in the Visa contract. There's a data breach or data protection in the contract, but there's no accountability with data breach for the merchants. And therefore, when you see TJ Maxx's and the Heartland payment systems data breaches, which affected millions of cards, the financial institution that issues the cards is left holding the bag. So we have to pay for reissuing cards. We are not allowed to disclose how the breach happened or who caused the breach, and that there's a cost for making that, or the cost for that business. Data breach, fraud, and credit losses have cost my credit union over $2 million in 2009. The interchange did not cover those costs. Just to wrap it up, this bill, I believe, hurts consumers. It does not help them. It is a cost of doing business for the merchants to have this program. It pushes smaller issuers out of the way and allows only the large issuers to compete. And as a credit union representative, we will stand up and fight as the California Credit Union League. We will stand up and fight for our members and for our members' choices. Mr. Chairman, on behalf of the California Credit Unions, thank you very much for the opportunity to address you.
Thank you very much. Let me open this up. Yeah, Mr. Ruskin.
So when you these interchange fees that you receive for the card, you don't outsource the security that
we do outsource that. Yes, there's a cost for that as well.
Do you? So, what I was thinking back to was some of the testimony from the opening panel, which said that if there were caps on fees, people would learn, institutions would learn to provide the same services for less and be more competitive. Is that something that? And does that? Are you that institution, or is someone you're outsourcing to that institution?
Well, I think both, and we are a not-for-profit cooperative, so we try to keep our costs as low as possible, and we do outsource the processing piece of our credit card system, but there would be additional costs if we're not getting the income to offset those costs. It's going to be difficult to continue that program.
Okay, thank you.
Yes, Ms. Torres.
So whatever, to all of you, whatever outsourcing you're doing, I hope it's being outsourced to California employers.
Absolutely.
Anyone else? Just let me ask, I think I have a pretty good sense of the answer. Of the three pieces of legislation that are being proposed on a federal level, is there any aspect of any of the three that any of you find agreeable? Okay, I think I got my answer there. All right, if I could have that, thank you very much for that enlightening testimony. We have another panel. This one's entitled The Impact of Interchange Fees. Mallory Duncan, Pedro Morias, Scott Hagee, Kelly Ritchie Davarin, and Michael Bernard, and Navdeep Basi. Mallory Duncan is representing the National Retail Federation. Pedro Morias of CalPERG. Scott, how do I pronounce the last name? Hauge, thank you, sir. Small Business California. Kelly Ritchie Davarin from the National Association of Theater Owners. Michael Bernard is from the Northern California Independent Booksellers Association. And Navdeep Basi, an owner of a 7-Eleven store. So we could please, who wants to go first? You, fine. Thank you.
Good afternoon. I want to thank you, Mr. Chairman, for inviting me to speak on behalf of the National Retail Federation. We represent virtually every type of retailer, from local mom and pops to very large national chains. And let me just say on behalf of the retail industry that no one believes in competition more than we do. Retailing is fiercely competitive. As a consequence of that competition, the average profit margin in the retail store is about 2%. Net profit 2%. Now, when margins are that tight, when costs go up, prices go up. But when costs go down, prices go down. That's the beauty of competition. We encourage it for ourselves and for our customers. Now, you've just heard the financial services industry tell you that everything is working fine and need not be examined. But in truth, this is a walking market failure. They don't want oversight because what they've got is a very sweet, privately regulated cartel. Since its inception, Visa and its big banks have gotten together, usually once, sometimes twice a year, and decided how much they're going to charge to process payments. Once that decision is blessed, all banks, you heard all about this competition among banks, all banks charge the same fees, impose the same rules, and merchants have to accept them. They have to accept the cards, the fees, and the rules on a take-it-or-leave-it basis with no opportunity to negotiate. Now, you heard a little bit earlier about, well, there's negotiations on parts of this. We should look at the whole merchant discount fee. In fact, here's what they're really saying. Interchange is about 2%. That processing fee that you asked for, one acquiring bank might give it to you for 10 cents. So on a $100 transaction, your cost as a merchant is $2.10. Well, I might find another acquiring bank that will negotiate that 10 cents with me and get it down to a nickel. So instead of paying $2.10, I'll pay $2 nickel. They will come to you and say, look, they save 50%. 50%. Well, it's 50% only on that 10 cents. The $2 set by Visa and MasterCard can't be changed. Now, they've recently changed their format, but they're still essentially price fixing. They're also fixing the rules. And the rules are designed to support the cartel and hide its operation from consumers who ultimately, as you've heard, pay most of these fees. I want to give you two brief examples because they were raised earlier. The first is what they call the non-discrimination rule. It prohibits merchants from giving a customer a discount if the customer uses the card with a lower fee. Now, this is a remarkably anti-competitive rule. It's like Pepsi and Coca-Cola telling stores they could be fined if they charge people less for other soft drinks. Its effect, of course, is to discourage lower costs of payment. Now, so if we wanted to say, give you a discount for Discover, we can't do that. Mr. Ruskin, you asked a question about how is this incorporated into the price of goods. Remember that 2% profit margin. We would willingly sell a basket of back-to-school clothes for 99 bucks. But if we take credit cards, we have to add 2% or we're selling clothes for nothing. So what happens, because they have another rule that says the price you offer to the public, must be the credit card price. So clearly we can't offer it for $99 because we'd go broke. So what we have to do is offer it for something close to $101. But look what's happened here. Everybody, whether you use cash, check, credit cards, or food stamps, is now paying $101. So that's how the price gets driven up. Now, in effect, interchange acts as a privately imposed hidden sales tax on U.S. commerce. And experience has shown when you hide the true price of credit, it doesn't matter if it's a subprime loan or a sneaky credit card, the public gets rooked. Now, as to transparency, most consumers, you've heard consumers are happy. Well, most consumers don't realize how much they're paying. They don't realize that when they use a reward card or push the credit button when using a debit card, that the transaction costs far, far more. Do consumers know that swiping rewards cards drive up prices? Now, it's bad for us, and as you've heard from Mr. Bolto, it's also bad for families who rely on cash. Last fall, the Hispanic Institute released a study revealing that the credit card operates like a reverse Robin Hood. They're taking money from the poor and giving it to the wealthy who get rewards. Now, the credit card companies not only take a piece of every retail transaction, they also take a bite out of the sales tax. When a card is used, the card companies assess their fee on the final register price. That means we have to pay them 2% of the amounts we collect for the state. Members of this committee, the sales tax is not our money. It's not the credit cards company's money. It's the people's money. Californians are hurting. So why should people have to pay a credit card company to collect money for the benefit of the state? In conclusion, I'd like to address 2 points that were just made. One of them, as I said earlier, consumers are in the dark. A year ago, 2008, interchange fees came to $448 billion nationwide. If you divide that across all households, that's $427. Consumers didn't know they were paying it. You know, if I had a credit card here and I said to you, I have this great product, it's called a credit card. Its annual fee will only be $427 a year. How many people would accept that? And yet that's what they're paying now. That's why we need transparency, and that's why we need competition. And as to this market being voluntary, oh, please give me a break. I'm old enough to know, or remember, Ma Bell. Ma Bell had a monopoly. Ma Bell was voluntary. If you were a business, they'd tell you, if you don't want a phone, don't put a phone in your business. But we were paying $1 for a 30-second phone call back then. And then what happened? We brought competition into the phone industry, the prices dropped, and we're all better off. The same should happen here, and we encourage you to move forward with this. Thank you.
Thank you. And any questions, members? Mr. Nilo?
Yes, on that last point, what do you encourage us to move forward?
We would encourage you to look at ways in which you can help make this more transparent. We would ask you to resist efforts that would further drive up the costs that retailers have in terms of charging their customers.
So you're not espousing a regulation of the rate itself. You're espousing a disclosure.
There's a lot of ways. This thing is very complicated. As you can look at that chart over there, you see how complicated it is. There are two things that are absolutely needed. One of them is greater transparency. Like I said, people don't know. The second thing is you have to have a competitive market. So there are a lot of ways to get to a competitive market. One of them would be to get rid of some of these anti-discrimination rules. One of them against the rules against price. They propose privately on pricing. There are a number of ways you could remove some of those rules. Another way of handling it could be to set in, look, as Australia has done, look at the pricing and say, does this make sense? I thought it was just 1 second, I thought it was very telling. Was it 2 weeks ago there was an article in the New York Times about PIN debit fees. And they asked the global representative for Visa, how do you set these rates? And you know what her answer was? It's not based on cost. It's based on the value that we think the consumers and businesses might get. So we increase the price to the value. It's not related to anything in terms of cost.
Are you going to suggest to me that the merchants you represent don't do the same thing?
I'm going to say the competition in a merchant environment pushes it to 2%. It doesn't happen here.
I get that, but that notion of pricing in accordance with value is what drives every marketplace because of the notion of maximization of profits within the volume that you believe you can get. And I just want to clarify that one point. I don't think there's anything sinister about pricing based upon value.
Not if it's constrained by competition.
Yeah. The issue of the price, $99 worth of goods, being increased by exactly the interchange fee to $101.
No, I said up to $101. It could be.
Okay.
Depends on the mix of cards and cash and other things in there.
You would grant that there are other factors that play into that pricing, including evaluation of the product that's being sold, plus the possibility that one might do more volume with the acceptance of a credit card versus not accepting a credit card, which can lower the effective margin that they're willing to accept if they think that they can make more money. So there are many factors. That's just one, but there are many factors that go into the decision of a merchant to set what his price is going to be, not just that incremental cost.
Well, obviously there are many factors, but if you're willing to sell it for $99 cash, you have to sell it for more if you take credit cards.
And there was an interesting point brought up about other factors that affect the price, the cost of doing business. Nighttime versus daytime, kind of a cute example, but frankly, no less accurate. There are many other factors that affect the cost of doing business for one transaction versus another transaction. Would you espouse trying to get at those things too, and perhaps have different prices for things based upon those costs to the extent that they can be as objectively as possible determined and do it by government regulation?
Well, it's the interesting thing about that example. For most of the,
I sort of dismissed that example. I said
I'll
it's
leave
cute,
I'll leave the lights out of it in that case. For most of the products and for most of the services that merchants get, they're actually able to negotiate those. So if I have a trash delivery guy who's charging me too much, I can negotiate and find someone else and do it for less, which helps me keep my costs down.
Not in
which makes
Sacramento
me,
County, you can't.
which makes me more competitive. So it depends on what the services are that we're looking at. With the credit card companies, as I said, it's a take it or leave it price. I can't negotiate.
Then the tenet is where there is a perceived lack of ability to negotiate that difference. I'd still suggest there are other examples of that, but thanks.
Sure.
Mr. Swanson?
Thank you, Mr. Chairman. The credit unions talked about customer relationship and the necessity of improving customer relationships by having access to cards. How do you value access to cards in terms of the ability of the business to survive, grow, and expand? I mean, is it a critical instrument in the merchant's ability to remain competitive and expand his business because so many consumers are relying on the availability of credit cards and sometimes different credit cards?
Well, we are in a world where, I think it was mentioned earlier, credit usage is rising, and it's becoming much more like currency. And that offers some advantages. As I said, like my example of a telephone, I mean, there are advantages to cards. The problem is you don't want the cost of that currency. You don't want to really say that $1 in the U.S. is only worth 99 cents because we want to make it more convenient. We have to have some method of making certain that the costs are reasonable. There are lots of services that merchants would like to offer, free gift wrapping, free delivery, but they have to be strategic. They have to decide what they can afford to deliver. The same, I'm sure, is true in the financial services industry.
But are we saying that the credit card itself is a critical it's critical to any business plan?
From a merchant standpoint, there are so many cards out there now that it's extraordinarily difficult for a merchant to operate and not take credit cards.
And there's no, we're not suggesting that there isn't capital costs involved in supporting that.
No, there are costs involved in issuing credit. Absolutely.
Yeah. I'm trying to look for what is a fair assessment of the situation given the practical. Some years ago I owned a small sandwich shop, and so I understand that 2% profit margin, but also I also understand everything costs, and so the question is, where's a fair balance in how you approach?
It's hard for us to do that on our own independently, but that's the great thing about competitive markets. Yeah. I think it was Mr. Balto who made a point earlier that when the covers were pulled back and people could see how much cards were costing in Australia, and the banks had to compete when they couldn't use someone else's money to compete with, they then had to compete on what they offered, which was the interest rate, and they dropped the interest rate.
Okay. And we all admit that this battle is probably going to be fought out in the national level, not in the
largely,
not state by state.
Thank you. Any other questions, Mr. Morias?
Thank you, Mr. Chairman. Members, for the record, my name is Pedro Morias. I'm the consumer advocate for the California Public Interest Research Group. CalPIRG is a statewide consumer group that stands up to powerful interests on behalf of California's consumers. As we have already heard today a few different times, in 2008, the banks in the U.S. collected $48 billion in interchange fees. Consumers and retailers are footing this bill, in theory, for some benefit, but the current system mostly benefits the banks. My testimony today is going to focus just on the impact of the interchange fees on consumers with three main points. The first one, all consumers, even those who pay with cash and checks, pay more at the store and more at the pump because these interchange fees are passed on in the overall cost of goods sold. The second point, the card association's rules prevent merchants from informing consumers on the cost of payment and the limit of the ability of merchants to direct consumers to the safest, lowest cost, and most efficient forms of payment. And then finally, this is an oligopolistic concentration. It has allowed issuers to engage in a variety of unfair and anti-consumer practices. So first, an example of the costs that get passed on to consumers. The so-called free rewards are a great example of what we heard called the reverse Robin Hood effect that interchange fees can have on consumers. Currently, all consumers are paying for the rewards in the form of higher prices for the goods they purchase every day. Only a small portion of card holders actually receive rewards, and the portion they receive is less than what card holders are paying in interchange fees. But most important, the most vulnerable consumers, those without credit cards, receive nothing from interchange and subsidize these supposedly free gifts of reward programs for more affluent consumers. And reward programs are just one example of how all consumers end up subsidizing cardholders, and how even cardholders are not getting what they pay for. The $48 billion in interchange fees U.S. consumers paid in 2008 is more than double what Americans paid in credit card late fees in the same year, and 3 times ATM fees. $48 billion is an increase from $42 billion in 2007, and an increase of 33% from 2006. Now, did consumers benefit from this rapid increase? Did cash customers benefit? Obviously not. Did the credit card customers benefit? Did the reward programs improve substantially? Were there greater benefits to card holders in some other fashion? Did the welfare of all consumers increase? In all of these things, we highly doubt it. So my second point focuses on the question that many consumers have encountered at the cash register, debit or credit. Most consumers are completely unaware that there's even any difference between the two choices. The interchange fee system is hidden from consumers and from the public. The card associations don't disclose publicly their fees or the basis of the fees. Most public reports maintain that on average, interchange fees cost merchants up to 2% or more of each transaction on a credit or signature debit card. What's considered offline or signature credit transactions cost the most, and then online or PIN transactions actually cost the least. As government does not regulate or compel disclosure of the credit interchange fees, most consumers have no idea that they exist and that they're paying for services that they may not even use. In fact, Visa and MasterCard and the card issuing banks engage in a variety of practices to prevent well-informed consumers from exercising their choices. For example, Visa and MasterCard rules prevent merchants from disclosing fees to their customers or attempting to steer customers to lower price payment options such as cash or online debit cards, online meaning PIN debit cards. They can't attempt to direct consumers to lower cost options such as cash, checks, and the PIN online debits. To ensure that market forces of competition work, consumers have to have an accurate and complete picture. So in conclusion, I want to just highlight a few of the unfair and anti-consumer practices that this insufficient competition has created. First, card associations and banks use misleading marketing to encourage consumers to use their credit cards or signature debit cards as frequently as possible. Reward incentives, such as frequent flyer miles, are designed to seem as though customers are paid to use the cards. In reality, these consumers and other consumers are simply paying for those rewards. The recent efforts of the card associations to convert cardholders from regular credit cards to so-called premium cards such as Visa Signature or MasterCard World Cards is a good example. These cards have significantly higher interchange fees than traditional cards and among the highest of all interchange fees. Second, although merchants can't surcharge or use differential prices to direct consumers to the most efficient and lowest price payment options, banks do have that power. Not surprisingly, they use it to direct consumers to less efficient, higher cost options. The debit card market illustrates this problem. Signature-based debit is more expensive and less secure than online debit because online debit transactions are instantaneous. Online debit has a far lower rate of fraud. Online debit transactions, meaning the PIN transactions, interchange fees are capped at fixed levels. They only cost merchants between 17 and 50 cents per transaction. Conversely, credit and signature debit cards cost merchants up to 2% or more of the entire transaction, no matter how large. Instead of promoting online debit, which is safer and less costly, banks increasingly surcharge consumers seeking to make these transactions with penalty fees of as much as 50 cents per transaction. Consumers are paying more for a less safe and more costly product. These penalties effectively steer consumers to the less efficient, less secure, more costly signature debit product. These examples show that card associations and banks use some of the same deceptive practices against merchants as we've seen them use against consumers for years. Not only do the merchants suffer as a result, but consumers unwittingly do as well. As we've sort of talked about what states can do, and you're right that mostly this will be a fight at the federal level, but I think the number one biggest thing that we can urge folks in the federal delegation to do is support the Consumer Financial Protection Agency, which basically would put a regulator at the table with the folks who are monitoring the banks and other financial institutions with an eye towards how to protect consumers. We applaud Chairman Nava and the Banking Committee for holding public hearing on this important consumer issue. We hope there is an opportunity to work with you on this and other efforts to protect consumers from anti-competitive tactics in this vital market. And thank you very much for the opportunity to testify today.
Thank you. Any questions, members? Yes.
Yeah, very quick. Is there a growing trend? I visited a number of restaurants and they have cash only, but they have an ATM machine in the restaurant. So I mean, is that happening more and more? And what do you credit that with?
Yeah, I don't know if it's a growing trend. We haven't seen any studies on it, but they certainly get away with not paying the interchange fees, and then the consumer ends up paying the $2.50 service charge or whatever it is on the ATM machine in the shop. So,
and I was just I was raising this because that seemed to, in the end, that would hurt consumers more.
Yeah. To
have that kind of arrangement because they don't have the cash. They go to the ATM and they pay the $2 charge and the price is not. Well, it's just a thought.
Okay. Thank you, Mr. Gaines.
Yeah. I'd like to just clarify a couple of issues, at least from my vantage point. When we talk about reform, number one, I'm always wary of any sort of reform that occurs because I think what's happened, if you take a look at the mortgage crisis and the credit card reform that's happened out of the Congress, I don't know if you've seen your credit card statements, but mine went from 5.9% to 18% in anticipation of new regulation at the federal level. And you take a look at what has happened to the mortgage industry. Clearly, we had too much flexibility in the mortgage market in terms of easy credit. But now that pendulum has swung in exactly the opposite direction to the point where folks can't even get a loan for their business or financing your mortgage is very difficult in this marketplace. So I've got, I guess, real challenges when we enter into what I think ought to be the marketplace in determination of the charge of fees for a credit card transaction or a debit card transaction. And I think the other issue that you have to keep in mind is one that was brought up by Sandra, is that you always have the opportunity to use cash, and some merchants are very careful in terms of how that cash is, or I guess the opportunity to pay cash versus a credit card with a discount for paying that cash. And so I guess those are some of the points and challenges I see when you start digging into this. I like the idea of taking a look at what happens at the federal level, but I think we need to do that with extreme caution.
Thank you. Now could we hear from Scott Hogue?
I'm Scott Hauge. I'm the president and founder of Small Business California. And I had the opportunity over the last few days. I also happen to be an insurance broker. So I contacted some of my clients and some of the members of the organization. I contacted an ice cream store, a restaurant, a clothing store, a hair salon, and a hardware store. And what I heard from them, these are not sophisticated people. These are people that are trying to make a living on a day-to-day basis and right now struggling. What I heard consistently from them was they want to make things as easy as possible for their customers. The reason they recognize that credit cards are important and debit cards are important is that it makes it easier to do business with them. Quite frankly, what they don't understand is why, while they want to make it easier for them, why if their costs are higher for taking a credit card than a cash transaction, why they can't differentiate between the two customers. They feel that the customers would understand that. That may not be sophisticated, that may not be the best political thing, but they're confused. The other thing that I heard with every one of them that I talked to is it's a very complex system. Whether they're a debit card or credit card, and whether they swipe it or whatever, there are just so many different rates that are charged on the various cards that, quite frankly, they can't figure out what they're going to be paying. And for a business, what is absolutely critical is predictability and knowing your cost. And they don't feel they know their cost or can evaluate their cost. And the aspect of negotiating, again, these are not sophisticated people. They're very knowledgeable, hardworking people, but these are not financial experts. These are people that are doing the sales, trying to do their books, bottle washer, etc. They just don't have the time to go through and break everything out because it's so complex. And therefore, if they can't fully understand it, how do you negotiate when you can't fully understand there's no transparency there? So that's what I heard from my customers and my members, and we think that there just should be a deep look into the practices that are going on right now.
Yeah, let me ask a question, because it occurred to me as I was hearing you explain this, and it may come out in testimony from this panel. But if you're a merchant and you have the agreement to accept credit cards, and it seems what I've heard is that the card has 5 or 6 or 7 different kinds of cards. You have some with rewards and some with not. So there's this whole buffet of cards that are available. Each one of the cards charges a different transaction fee, correct?
Yeah.
So how does the merchant come to learn what the cost of that transaction is? Where does that appear? Can you answer that for me?
When you take a credit card for a transaction, at the end of the day, you batch out and you see a record of the transactions.
Okay.
And you get a number that you can plug into your books and say, we took in $1,100 in credit cards.
Okay.
Today. At the end of the month, you get a statement for your credit card processing company that tells you on the 30th of January you took in $1,100. It does not itemize the transactions for that day.
Okay.
It just gives you the day value. And then you are told you over the month you took in 574 Visa transactions at 1.89 cents per transaction plus 15 cents per transaction. You took in 122 MasterCards at 1.89 cents plus 15 cents per transaction. And then below that is a table that tells you that all these different classes of cards were accepted. Rewards 1, of your 700 transactions, 174 were Rewards 1 transactions. And those transactions were worth X amount.
Got it.
And so they carry an additional basis point,
right,
which translates into this amount.
Right.
But you can't ever go back and say any single transaction cost you this.
Okay. And I think what I'm now beginning to better understand. If at the end of a particular month you get that statement and you see that the reward cards that you accepted during the course of that month cost you, let's say, $500 in fees, but within that same family of cards, there was one that was not a reward card, and it cost you $200 a month, under the terms of the agreement, you as the merchant are prohibited from posting a sign on your register that says, I do not accept X bank reward card. Is that
you must honor all cards according to your processing agreement.
Okay.
You can choose to exempt an entire class of cards. For instance, most small businesses don't accept Discover Card.
Okay.
and only 5% of consumers use Discover Card. You can not accept American Express.
Right.
And again, only about 24% of consumers use American Express, although they have been well trained by American Express to make an unholy fuss if the card isn't accepted.
Right.
We've lost transactions not accepting American Express.
But the point is that
you can't say you don't take Visa signature.
Exactly. So it's like you may not like that particular cousin who comes to Thanksgiving, but you can't prohibit the whole family from sitting at your table. Right?
Right.
Okay. I'm just saying that's part of the agreement.
I did talk to I mentioned I talked to a hardware store who happens to be an Ace hardware store, and he felt very fortunate that he had the negotiating power of Ace behind him. And what they do is they give them a flat rate. However, what he said is at the end of, I don't remember whether it was a month or a quarter, they then bill for additional charges by the use of the cards that they accept.
All right, questions of, okay, let's go to, is it Kelly Ritchie Savarin?
Davern. Yeah, my name is Kelly Ritchie Davern.
Davern, sorry.
Davern with a D.
Okay, somebody's getting fired. It's misspelled here.
No, I understood that. I'm the Vice President of Theater Operations for a small theater circuit of 11 locations in Los Angeles, and I'm here testifying on behalf of the National Association of Theater Owners for Trade Organization for California and Nevada. Historically speaking, the theaters may have been among the last vestige of a cash business, given our low price points and the greater societal shift that we've all been testifying to from paying with cash to paying with cards finally reached us this last decade. And again, for my company, 70% of our total revenue now is represented by paying with a credit card, one form, or a credit or debit card, rather. So again, usage has gone up as well as fees. So we, again, certainly sought to appreciate some of the upsides of that shift, the convenience offered to our guests, the speed of transaction versus cash, as well as having less cash in the theater locations, possibly improved safety, and we were definitely grateful for that. But that initial appreciation certainly wore off quickly as the expenses associated with 70% of our revenue coming from cards continued to mount. So in the last 7 years, from 2002 to 2009, card fees we were paying have almost tripled. In 2002, these fees represented 0.6% of our total revenue, and in 2009, they were 1.7% of our total revenue. An earlier panelist mentioned the costs that there are costs associated with all forms of payment, and absolutely true. And the cost of cash to us is 0.1%. So certainly not in the range of 1.7% of total revenue. So it's in a league of itself. Theater owners are particularly impacted by these substantial usage fee increases due to the combination of the low dollars per transaction as well as the multiple transactions in the way a guest flows through our business. So you go to the box office, you buy a ticket. Again, our national average is around $7.45 for 2009. That carries a flat fee of a swipe fee, which is 25 cents. In addition to that, all of these other calculations that we were just mentioning around discount rate, chargeback fees, in addition to the interchange fees, which for us can carry an average transaction fee of about 57 cents or 3% of total revenues. Again, these numbers I'm quoting are using my company as a proxy. I don't have access to all of the theater exhibitors in California, but we think we represent a pretty representable cut. So of that 57 cents per average credit card transaction, we think a third of that is purely the interchange fees we're discussing here. And again, the complexity, the panelist to my left just went through. It's very difficult for us as a smaller circuit to even identify how to slice and dice and understand fully the amount of those fees and where that 57 cents is coming from. We just know it's costing us $1 million more this year in interchange fees than it did in 2002, and those fees, that expense has to be made up elsewhere.
let alone being able to, if you can understand it, maybe we could devise strategies to drive consumer behavior to stronger and less expensive forms of payment methods. But without that understanding, we're completely at a loss. As many have mentioned on this panel, the profit margins in our industry are also very tight. The margins are measured in pennies, and we're profitable only through volume. And the increases we've seen in these fees have had to be made up elsewhere in our business model in order to meet our return on investment expectations. Mostly in my company, these increase in card fees we've used to offset tactics in increased pricing as well as decrease in payroll. And in our business, payroll represents the largest controllable operating expense. So just in kind of doing a sum of calculations, so during that period, 2002 to 2009, which card fees have run us, have tripled, 300% more than we were paying in 2002, our average ticket price has only increased 22%. And again, unlike these interchange fees that lack transparency, usually when movie ticket prices go up, it's kind of like gasoline and milk. It's front page news. So we don't have the benefit of kind of hiding that. And our payroll as a percentage of revenue has had to decrease by close to 2%, again, in order to offset these costs and meet our bottom line margins. Generally, what's that mean to a local theater chain? That's when I did the back of the envelope estimates using our theater chain as a proxy. That was 10 to 15 fewer staff. And again, our majority of our workforce is first-time teenagers and first-time job holders, teenagers and maybe up to 22 years of age as they go through their educational goals, or senior citizens, retirees looking for supplemental income. Or it's either fewer employees or the employees we have working fewer hours, which that could mean 240 to 360 fewer hours scheduled per week per location. So this has real ramifications on our the paychecks of our employees, and or one less management level employee. And most likely it's a combination of all those tactics for every theater operator. So the savings to us in the reduction of counting less cash, again, as one of the earlier panelists intimated, that would be 24 hours less counting cash. It's certainly not in the realm of what I'm just talking about with these increased credit card fees. So while there have been some saving, it's not been in the ballpark. So the increases in the amount of money spent on these card fees has negatively impacted the movie-going public through higher prices, our employees through fewer hours to be scheduled, as well as in the communities we operate with fewer offers for employment for the workforce. So as an industry, with so much to offer our guests and our employees and our communities in which we operate, we certainly are grateful that you're taking this step and helping us, again, examine and find a way through to still meet our margins and offer the consumer what they really need.
Thank you. Let me, in thinking about some of the arguments that were suggested why the credit cards are helpful to a particular business, there was a reference to, like a furniture store. And if you sold furniture, the certain level of anxiety that the store owner would have as the person loaded the Steinway in the back of the pickup truck and drove away, and all you have is this check. Well, that's not your business. No. Have you seen anything that suggests, as an industry, that you've enjoyed increased ticket sales per theater based on people using credit cards or debit cards?
No, we have not. Again, it's been a convenience factor, certainly, as others have, just people carrying less cash and being appreciative and really requiring, as we compete in the marketplace for as many theaters, we have to accept credit cards because that's considered, of course, you'd only go to a theater that accepts cards payment.
Now, do you have any information that based upon the nature of your particular enterprise, movie theaters, and some of the protections that have been promoted by the industry, incentives for people to spend more money, security for the merchant that they're going to get paid, that any of those, the fact that you don't really have any of those advantages is in any way reflected in a negotiation for the interchange fees in your industry?
No, no, I don't. I don't feel that there's an upside there. And in fact, I also noted, again, an earlier panelist mentioned that these chargeback fees, I think it was a person from one of the banks, said, they assume a great deal of fraud accountability. And quite frankly, in our chargebacks, we lose 95+% of the chargeback where a guest says, I wasn't there, I didn't go see a movie. And we have an authorization, an approval, a signature, and we still lose. We're not able to capture that money. And it in the 95 percentile of that we are out of the good we sold. So I think the banks are passing that on to us as well. At least that's our experience.
Any questions, Mr. Nilo?
One, you confused me a little bit when Mr. Nava asked if you believe that you gain ticket sales by accepting the credit card, and you said no.
Yeah, I don't believe we have increased movie going simply through
Why don't-
accepting because of it's a low dollar item
I understand. Why do you accept it then?
for convenience. Again, because
What would happen?
we held out on in our circuit. We did hold out on accepting credit cards.
And
The
what
larger
happened?
Change, a great deal of customer backlash of we're being, why aren't we doing this? Why aren't we staying competitive with what our competitors are offering? And the larger chains like AMC and Regal and such were definitely leading that. And so we went along with that again, first starting with, well, we're not going to accept Discover and American Express. We're going, and now we have had, given the societal shift, had the pressures to.
Was it your belief or not that you would have lost business had you continued to not accept credit cards?
I think we would have lost business. I don't think we gained business. I don't think movie going increased nationally because of credit cards. I think we were able to hold market share because people would have gone to a competitor to see a movie, but I don't think movie going would have gone down if we as an industry didn't. But as a chain, if we did not accept credit cards, our movie going would have gone down.
Your movie going would have gone down, but accepting it, you wouldn't have gone up.
We were able to maintain our marketplace.
You realize how that's a difficult
I'm saying
phrase to
because a competitor broke the
reconcile.
marketplace and said AMC across the street's accepting credit cards and Pacific Theaters is not, I'm
Right.
going to go to AMC.
Which is-
None of the movie chains had ever accepted credit cards. I don't know. That would have been an interesting experiment.
Right.
Right.
Which is you
Somebody
just
broke it.
told a fairly typical story of a marketplace.
A competitive marketplace.
Exactly. One participant felt that they'd gain market share by providing an additional service, and then all others recognized that they would too. I just not so much to enter into a debate with you, but the statement that you made about it didn't gain sales for you, but if you didn't accept it, you would have lost sales. I couldn't reconcile that. I think I understand what you were saying now.
Only because of the movie Cross the Street. Exactly.
Mr. Chairman.
Yes.
But if all your theaters showed Avatar, you guys be doing great, right?
Oh, yeah. If only.
For the 3D.
That was a weekly happening.
It'd have to be 3D, though.
No, I've seen it 4 times. So
yeah.
Absolutely.
Did you probably kept it?
No, I used a credit card.
Did you get back the glasses?
And you had earlier brought up the piece of having ATMs in our lobby. Initially, that is absolutely what we did to try and still stave off having to offer such, accepting all of the card fees. And we knew that was it was negatively impacting our guests because they had to wait in the line for the ATM and then come over to the box office to buy their tickets. And so it was a consumer dissatisfaction, which again increased the pressure for us to simply accept all cards.
Yeah. It just seemed that and follow up on Mr. Lido's line of question, it just seems that as the marketplace is moving, I mean, people are using the credit cards, and so those that are not using the credit cards, I assume the prices are increasing because people are using the credit cards according to your testimony, and but those that use cash, then I guess they're supplementing that payment because that payment then is a cash payment. So it doesn't, and so I don't know what the numbers are you know. So, but that's also an interesting analysis of, you know, because that cost, because it's $99, I'm going to pay the 102, and I pay you cash the 102. Well, that fee that's not a transaction fee that gets passed on, but it's also bid into the cost of doing business, I guess.
Well, what happens in that case is most merchants, because they are competitive, try to balance it out so they can increase their costs as little as possible.
Yeah.
Mm-hmm.
But that net effect of that is a piece of every transaction goes off to the card companies.
So the point, and trying to follow, you know, my distinguished colleagues' logic here, is that the marketplace now says they want it to be convenient, and there's an investment that's been made into the availability of these cards, and so the question just becomes, is that just the cost of doing business or not the cost of doing business? And that's the question has to be answered honestly and forthrightly to try to negotiate some reasonable position.
Yeah, and in the direct operating expenses, again, it is one of the only line items in which volume's not helping us, and we're unable to use volume to then negotiate better terms. So the flat transaction fee, we are able to negotiate that, and for us, that's a quarter every transaction. So if you go to the coffee bar in our theater and average transaction $3.50, at a minimum, if you pay with a card, I'm paying out a quarter to make before cost of goods are even taken out, $3.50. So again, these small dollar amounts and these multiple transactions that take place really have ours up at 3% of total revenues, which is slightly less than retailers, because I'm assuming it's the multiple transactions and the lower average transactions.
Thank you.
Thank you. Mr. Gaines, do you have a question?
Yeah, if I could just follow up on the use of credit cards, because it seems to me that if your competition is doing it and you're doing it, then you've got an even competition occurring within the marketplace. Certainly you're paying a fee to use a credit card or a debit card, but if your competition is, then you are matching the competition within the marketplace. And so I'm not quite clear as to what your argument is. If it's being matched with it, you're not at a competitive disadvantage that I can ascertain in terms of what's happening within the movie industry.
Well, I guess in the 7-year period that these fees had, again, a combination of usage and the rates going up have increased 300%. And while we're in competition with
that would happen to
we've all seen our bottom line go down.
Okay, but that's happening within the industry, and then, you know, another option of the industry and the competitors would be to raise prices commensurately.
Right, and we know how damaging that would be to the movie-going public, because we want to keep it very widely accessible as the best value of out-of-home entertainment. And you're right, it's a competitive choice we're making, and it's only gone up 22% in the same 7 years. So,
but it hasn't, from what I've been reading about box office hits, it's not keeping people at home necessarily. I mean, they're willing to pay the money to go to the theater, and if the competition in the marketplace for theaters, if I have several choices, as a result of, you know, using a credit card transaction, if everybody's paying the fee, then for that convenience, everybody's paying that fee on an equal basis, as far as I can tell.
Yeah, I mean, larger chains, I imagine, don't pay 25 cents on the negotiable things. I imagine.
Okay, as a chain, I guess there's market power.
We're smaller, so
true.
So
that's true, but that's true in any business. I mean,
absolutely.
I'm in the insurance business too, and I see my larger competitors negotiating better deals with the companies they represent in order to sell their products. So,
we'll introduce a bill on that.
Okay, yeah. Please don't.
Appreciate that. Just a comment. The assumption there is that the small business totally understands their fees, and they don't.
All right, let's move to Mr. Michael Bernard.
Thank you, Mr. Chairman. I'm Michael Barnard, and I own Rakestraw Books in Danville in the East Bay, and I'm also the president of the Northern California Independent Booksellers Association, a trade association representing 250 member stores around Northern California. And I've, over the last several years, made myself into the trade association's sort of knowledgeable person on this subject, and I've taught classes on it, how our business owners can best maximize credit card processing or minimize credit card processing costs while maximizing profit. And I've been thinking about this over the last several days because I'm teaching on it again in a couple weeks, and looking at the changes of the last several years, the last several months. And I want to sort of jump off a couple things that other people have said here today. Looking at the costs that face our business, at the top of the scale, our first cost is cost of goods, which for us represents approximately 60% of every transaction. Our next two costs, and they kind of flip back and forth depending on the season, are the costs of occupancy and the fees associated with it, insurance, electricity. We actually keep the lights on all day, not just in evening hours. And then we have the cost of wages and salaries and the fees and the insurances associated with that. And then the fourth cost is the cost of credit card processing or payment card processing. Of those four top-tier costs, payment card processing is the only one where I can't tell you with any degree of perfect certainty how much a particular transaction costs my business. If I buy a $25 hardcover from Random House, I pay them $15. If I want to pay my rent a month in advance, I pay so many $1,000s out to my landlord. If I decide to increase the hours at which I employ someone, I know how much I will pay them in salaries. I know how much my workman's comp is going to go up. But if you come up to buy that $25 hardcover from my sales clerk and you present a credit card, I can't tell you how much it will cost me. I can tell you the base that it will cost me. But depending on whether it's a corporate card or a rewards card, or if it ends up being manually keyed because the magnetic stripe is dead, or because someone neglects to enter a piece of security information, or in the case of customers with P.O. boxes rather than street addresses, there isn't the ability to enter the security information because it's a numeric system rather than alpha system. Those costs go up, and you can't ever come back to a single transaction and say what it cost you. And the way the statements are designed or the way the statements are presented at the end of the month, not only can we not say what a single transaction cost, we can't isolate a single transaction. If one is vanished from the whole month, I can't tell that it's gone. And that just seems to be, every single line item, every single book I buy from a vendor, I can find it on an invoice someplace. But every single fee I get from a credit card processing company, I can't find them. I can't come down to one item. And that just seems to be, and then that just seems wrong. It's so complex. It's so non-transparent. And then within that, we can imagine a system where we could isolate the individual transaction and the costs associated with it. We don't have the room to negotiate even with that knowledge. That even if we were to understand the exact implications of a particular transaction, I couldn't go back and say to the customer or to the issuing bank or to my credit card processing company, no rewards cards because they cost a penny a dollar more, or no corporate cards, or no cards where we end up having to manually key the transaction. If a customer asks, what would you prefer? I can tell them what I would prefer, cash. It doesn't cost very much. And indeed, since we recycle most of our cash, it costs nothing. Or checks, because in our market, I've been doing this for 15 years. I've received probably a dozen bounce checks in 15 years. Checks are essentially free. But we come to credit cards, and the costs go up, and they go up in an uncontrollable way. And they say, we're protecting you from chargebacks or identity theft or whatever. I've had 2 chargebacks in 15 years. How much is my business costing them? And are the rates that I am paying actually scaled against the value of my particular business? And again, transparency. I would like to know how much these things cost. And I don't, regulation, reforming the market, I don't think reforming in the direction of greater transparency is particularly burdensome. I don't think the government has to set the price, but I think it might be nice if the government would help us learn what the price means.
So of the three measures that are being considered at the federal level, are those measures that, insofar as the testimony we've heard and the people that you represent, you would support?
I think we would support any measure that ends up with a greater transparency, with a market that is more competitive. One of the panelists earlier said that when he was in business, he got a phone call or two every week offering to take over his processing. We get phone calls pretty regularly, and when I sit there and I'm sitting there at my computer and I answer the phone and, oh, we're selling you this, or we're offering you this, and you ask a couple of questions. Well, what are you going to charge me? Can you give me something in writing? Oh, no, we have to look at your statement. You know, we have to compare several months of statements. We don't give quotes over the phone. We don't give quotations in writing. If I run their company name or a phone number into Google just because I can, and I'm trying to figure out what's going on, every single one who calls has a litany of customer complaints that'll show up through the search results. Mm-hmm. And so how can you trust what you're hearing? And you can't, mm-hmm. Because then you come back to, this product is not particularly transparent and not particularly negotiable. Well, how can I really believe them when First Bank of Cornhusker State tells me that they're going to charge me less per transaction than B of A is? Mm-hmm. Are they not going to make it up in other ways that aren't disclosed? No. Statement fees, compliance fees, a monthly service fee, a you must rent the equipment from us fee, and equipment rental comes to $2,400 over 3 years versus buying the machine, which is $400.
Right. Right.
Sure. That's not a particularly useful competitive environment.
Thank you. Can I hear from? Thank you, Navdeep Basi. Did I say it correctly?
Yes.
Thank you.
Chairman Nava, Vice Chair Nilo, and members of committee, I appreciate the opportunity to discuss credit card interchange fees and negative impact of this fees on convenience store industry. I'm here on behalf of 7-Eleven and 6,500 U.S. stores, including 1,375 store locations in California. Our franchise community and our customers, and I am here today to shed light to keep light on a best-kept secret of credit card industry and its interchange fees. Sorry about that. It's my first time here. As you all heard, an average American paid $48 billion. In America, we pay $48 billion a year, and about $427 an average household pays for these fees. These fees amount to more than all credit card late fees, over the limit, annual fees, and cash advance and ATM fees combined. I wanted to tell committee that last year our industry made $1.3 billion. That's the whole convenience store industry. And we paid $1.6 billion into credit card fees. That's a direct evidence that we're paying more money to interchange credit card fees than we are actually making. And we're the small businessmen out there. As a small businessman, we're not asking.
Why don't you go ahead? He has a question.
Mr. Bassi, can you repeat that what you just said, that statistic?
In 2008, the whole C-store industry, convenience store industry, made $1.3 billion into profit.
And which industry is this?
Convenience store industry.
Okay.
Yes.
And
the 7-Eleven gas stations, the convenience mom and pop stores, all together.
So $1.3 billion in profit, and your fees were?
$1.6 billion.
Okay. And so were the $1.3 billion in profit after paying the $1.6 billion in fees?
I believe yes.
Okay.
Yes.
Well, I wanted to be sure there wasn't running a net loss. I mean, I didn't know.
Yeah, we thought you might be from the Department of Finance. Please continue.
As a small businessman, I'm not asking to do away with these fees. I understand their cost of doing business. I'm willing to pay fair market fees for the credit card services. But again, I operate my businesses in very competitive market. My margins are also between 1% and 2%. And our business, we compete every day, and we know what the fair price is. Credit card companies, they don't know, they don't understand, unfortunately, what is the fair pricing, because they never negotiated with us. All they ever do to C-store industry said, okay, this is the rate you're going to live with, and we have no negotiation power. Credit card companies such as Master and Visa card set their interchange do not set their interchange rate in competitive environment. Instead, they set their interchange rates in anti-environment monopolistic way, leaving their retailers and with ever increasing uncontrollable expenses. In fact, interchange fees are the only expense that we cannot negotiate. To add insult to injury, credit card companies require me to operate under rules that prevents me to setting minimum charges, require me to accept all credit cards. And that prohibits me from making preferences based on type of cards, and prevents me from reviewing the rules of practice without signing a non-negotiable agreement. It is always take it or leave it proposition for us. In reference to these fees, they also have a negative impact on our economy. As you know, California is reaching about 12% unemployment rate. That these fees prohibits us that we cannot hire any more employees. If I'm paying as a small businessman $15,000 to $20,000 into credit card fees in the store, there is no way that I can afford to hire an extra employee or a part-time employee. So therefore, we feel that it also is putting a burden. And in last year, 7-Eleven paid in California $35 million in credit card fees, and actually in year 2008. About 5 years back, 7-Eleven as a whole paid about $40 million for credit card fees all through United States, and year 2008 we paid over $200 million in credit card fees. That was more money that 7-Eleven showed on their bottom line. Finally, California, in summer of 2009, we, all the 7-Eleven franchisees, has started a campaign to collect signatures on a petition to ask Congress to help us to reform the interchange fees. And we were able to collect 402,000 signatures in the state of California alone. And totally, we collected 1.7 million signatures nationwide. In September, we went to Washington, D.C. We requested Congress to interact, and here we are here to make the same request to you that help us, because the credit card fees are the second highest expense that we have behind payroll, that which we cannot control. Payroll is something that we can control. I can maybe go and work 4 or 5 more hours when business is down, but there is no way I can negotiate any credit card interchange fee. So I'm here to ask for your help, and looking forward to work with this committee in any way, shape, or form. So, any questions?
Any questions, member of the committee? No. Yep. I think you thoroughly impressed everyone with your presentation in terms of what these numbers represent. I want to thank all of you for offering your testimony. Now we have a chance to hear from any member of the public who wishes to express their opinion. You can come up as soon as these folks leave the table. Now, those members of the audience who are small business owners who have experience with the interchange fees, would you raise your hands? Okay, keep your hands up if you like the interchange fees. Okay. All right. Yes.
And just since we're doing a survey,
of course.
Do you how many attach the projected cost of the credit card onto the cost of the merchandise? Show of hands. Okay, thank you. Just curious.
Please.
Respected members of the panel and Mr. Neva, I just made some observations. I did not come prepared with any notes, but
Would you be so kind? If you'll just tell us your name for the record.
I'm Manjit Purwal from Greater Bay FOA. I'm a franchisee from Vacaville.
Thank you. And
some of these observations are glaring, and I see the distractors and deceptions thrown in. But some of the parameters, it was so clear that interchange fees are so high. If you combine all the credit card fees, they still are more on interchange on the fees. And to me, presentation was very objective. Even without the relevance of figures, because I could see the shift, I could see the overall scenario, what needs to be done. And then there was here, how the cost goes up. I think that's been established because 27% of the public is more or less compensating 73% of the people who are using credit cards. But then it was said that credit cards are intimate to business, and in the same breath it was said that, we don't have to have them. We're not forced to have them. How contradictory is that? Because it's not an option not to have a credit card. Having credit card makes good business sense. And that's why the lady said here, with credit cards, I'm not increasing my volumes, but not having credit cards, I lose with business. That's happening because the cash flow, the cash purchase is shifting to the plastic. So just to hold on, sustain our current volume, we don't have a choice not to have a credit card. And to give that example, as I said, distractor, it's like a night shift at store, we have the lights on, charge more. I found that very absurd because, during the daytime, we have double shifts. We have 2 or 3 employees. So what are we saving? Few pennies in lighting. We pay a lot more in the payroll. So, to throw examples like that tells me how, it's just getting away from the subject matter. And average transaction, it was told us, is 44 cents for $100. Now in 7-Eleven, an average transaction is around $6. It's not $100. So I'm paying 44 cents on $6, not on $100. And about the studies, they were taken with a grain of salt. What's the Australia study? The largest convenience store in the world is 7-Eleven. Almost all their studies come from Japan. We don't, look at the difference in 2 countries. Studies show you the direction, basic scenarios. You can take studies, then you can tweak and throw in the factors and learn from them. And then again, saying that credit cards are wonderful. Of course, they're wonderful because, in the cashless society, we don't have an option but credit cards. And last, again, I would like to emphasize on this because any business that's not transparent, that's not competitive, in a way, it does become monopolized. So we do need transparency, we do need competition, and itself, then that will come to the level, like the gentleman there gave a wonderful example of phone business, how we were paying so much, and now it's, how we are enjoying. So more or less, this is my scenario of the observations that this interchange fee needs to be transparent, and there needs to be competition in it. And saying, we don't have a choice, we have a choice of not having credit cards, it doesn't work like that. And having two-tier prices is just not pragmatic. Thank you.
You're a small business owner?
Yeah, 7-Eleven.
Yeah, thank you. Would you care to speak next?
Just one.
Oh, I'm sorry.
One
Please.
quick question about the last comment that you said. Having two-tier prices is not workable. I think that's what you said.
Yeah, you see, I'm a franchisee, and that's then the other player, 7-Eleven, comes into it. Just putting on a shelf, if you have a cash, you pay this much, and if you don't have a cash, you pay that much. It's more cumbersome.
I understand that,
yeah.
and I agree with you,
That's
too.
why it's not pragmatic for us.
In fact, I personally believe if you were allowed to charge differently or give a discount for cash or whatever, there would be that business that would see the advantage and would advertise, I won't charge you more for using your credit card. So what's the alternative then? Is just don't pay interchange at all?
No, no.
Or you want me to decide what interchange should be?
No. Interchange, as I said, the speaker before me said, if there's a transparency and competition, then the fee will adjust itself.
Transparency, so that now there's an interesting point also. I don't think there's anything that stops you right now from informing your customers about interchange and what it is. The agreement says that you can't charge a different price.
Most of the customers don't even know what they're being charged.
I understand that. So how is any law that we pass going to create their understanding of it? See, you made a very poignant comment. Everybody else has been asking for the ability to charge a different price, which the agreements in most cases prevent you from doing. And I understand that point, and even I can even buy into it as being a retailer myself. But I'm thinking, I don't think that I would do that because then I would be subject of an advertisement by another retailer would say, I won't charge you to use your credit card, because the fact of the matter is people want to use credit cards. And so I'm not so sure that allowing retailers the ability to charge different prices would really end up with them actually charging different prices. And you supported that concern of when you said it would be cumbersome, and I agree. So how is it that the government can come in here and provide some regulatory framework that's going to solve the problem that you're talking about? Because what you're saying is, number one, you like accepting credit cards, your customers like using credit cards, but you don't like paying the interchange fee.
No,
I
didn't
get
say
that. I'd like for people to work for free for me too, but where is it that a regulatory rubric could solve these problems?
I didn't say that. Neither the speakers before me. No. We're saying it need to be capped or regulated. We're simply saying it's out of hand.
So what you're saying is the regulation should regulate what the interchange fee should be.
See, at the moment, I'm saying transparency because the first step here is to see where the folly lies. So I'm saying I'm pointing my direction, which direction we need to go and sort our house out. Then that's the next question. We are saying we can sit one day or send surveys out, and then we can come lots of answers to that.
Okay. Well, I appreciate the testimony, and unfortunately I'm going to have to leave in a few minutes because I have to be somewhere a distance from the Capitol by 6, and the traffic's terrible now. But this conversation is the essence of my concern about this. This comes under the title of "Be careful of what you ask for because you just might get it." I don't know that you want us deciding what the interchange fee should be. I don't know that we want to decide that in a political environment. Transparency is a good notion, but will people really understand what that means? Allowing you to charge different prices for different types of transactions can be a valuable thing, but I'm not so sure it's really workable in the marketplace. Every potential answer creates a question that begins to make the current system look maybe not all that bad. But I'm sensitive to your concerns because I'm a retailer too. I would prefer to be able to accept credit cards and not pay for them.
You're alerting me by saying be careful what you're asking for. I mean, the way I see it, we come here not to make things even more worse for us. Okay, now let's charge the same. Let's keep it monopolizing, but change the whole verbiage or the script. We're not here for that. We are here to really sort out the mess. And once I think we focus on that, we'll find answers.
But you're going to have a chance to participate as well. Please go. If you give us your name and who you represent or your business.
My name is David Hendricks. I come from Murrieta, California. I'm a 7-Eleven franchisee. I want to thank the chairman and the members of this panel for taking the time to listen to us, entertain us. Mr. Nilo, please hold just a second. I know I have a plane to catch at 7:02, but you've been very vocal, and I would appreciate your attention here. There's so much that I've heard here today. It's an education, and I really appreciate the diligence that you guys are applying to this. And I think it's wrong to ask for change for the sake of change also. We don't want you to regulate fees. What we want to do is open negotiations, stop a monopoly, create an opportunity to address issues that were bounced off of these tables today. I heard misstated facts, fractured facts. I heard statements that were untrue, not relative to fact. I asked for this chair today whenever we came up here because the gentleman with the banking group that sat here did such an elegant job. As long as he was talking, I thought I'm here for the wrong reason. He had me convinced. And they did a poll, and they surveyed the consumers, and the consumers were in favor and happy with their credit cards. Perhaps they need to poll somebody outside the banking industry or their family because 7-Eleven did a poll. We did a petition drive, gathered 1.7 million signatures, 400,000 of those, I believe, from the state of California. Consumers who say, we didn't know about interchange fees because no one's ever explained it, we don't like it, and we think somebody should intervene on our behalf. Now, we got a great system here in America, and we elect representatives like you to help protect us and take care of us. I remember in the mid-50s, General Motors Corporation had a monopoly less than 50%, and the government intervened and broke them up into 5 separate models. I remember when Microsoft had a monopoly more recently. It was brought up whenever Ma Bell had a monopoly and there was intervention. I believe the facts stated today said that 10 major banks control 88 to 90% of the interchange fees and the transactions. And I believe with the most recent acquisitions, we could probably narrow that number down to about 6. Now, if that's not close to a monopoly, I don't know one. When we did the survey, it was quite simple. We didn't go out and harass the people. We didn't ask them. We explained very simply, do you know what interchange fees are? We have a petition drive to try to get Congress to intervene on our behalf, to open these fees up, to make them transparent, to get us the ability to negotiate those fees. Now, I know for a fact 7-Eleven has tried to negotiate those fees with Visa and MasterCard, and today they sat right here and said, we'll negotiate any time. I bet I can go get Mr. Joe DePinto, the CEO of 7-Eleven, and he will tell you, like he has us, they won't negotiate. And our contracts and our agreements for those 6,500 stores are so restrictive that we can't stop taking the cards. We have to take all cards. We can't have dual pricing, and we can't select what we're going to do. Now, I know no one on this panel would do it. I'm sure of that. But I have people come in my store, and they buy a 25-cent pack of gum, and they use a debit card, and they want $20 cash back or $40 cash back. How much money did I make off that transaction? Because I pay 2% on the entire transaction, including the $40 cash back, I paid for his gum and paid for him to get money from me. And that happens in 6,500 stores in the United States, just 7-Elevens alone, not counting the rest of the convenience industry. I appreciate your time. I appreciate your consideration. And I wish I had the ability to analyze like you do. I want your help. I'm sitting here euphemistically wearing 3 shirts today. I have a red shirt as a merchant and a 7-Eleven franchisee. I have a shirt on under it that says that I am a consumer. And if I take those shirts off, I have a T-shirt on that says I'm a voter. If I take the next shirt off, we got a picture opportunity nobody's going to like. I'm here to ask you to give us, and I thank you, and I appreciate you taking the time to sit and wait for me. This is an important issue, and it affects every consumer in the United States. We are a credit-based country. Yes, it is convenient to use that card, but we've come so dependent upon using that card that we have allowed these people to set fees and not negotiate it, ignore us. I have a quote back here that I can get for you, and I would gladly pass on to any of you. Whenever interchange fees were first brought into place, there was some doubt about why they were coming into being, and that was a long time ago when our economy and our country and everything else was young and different, and everybody was trying to build credit. There was some research done by a professor at Georgetown University, and his conclusion was that interchange fees were created the way they were so that they were not impacted by usury law, they were not impacted by any regulatory issues that would restrict their ability to charge what they want to charge. I'd be glad to provide that to you because we're here to get information today, and if there's been research done to prove that, I think it opens a different door and a different window.
As a chair, we're certainly welcome. You're certainly welcome to provide that to us. We'll make sure the members of the committee receive it.
Thank you. And I thank you, and I appreciate your questions. It keeps us on our toes.
Next member of the public, your name and if
my name is Jazz Dillon. I'm from Los Angeles, specifically the San Fernando Valley. I have one store. Again, when I echo whatever everybody's saying, but what need the panel, I thank the panel for listening to us. What they need to understand is I have one store. It's not 7-Eleven Inc. It's me, Jazz Dillon, that has to pay that fee. I don't have the power to negotiate, neither does 7-Eleven, but it's affecting my bottom line. And we do have to pass on the cost because the consumer that Dave Hendricks said sign on our survey, they understand that they are paying that cost indirectly. That's why 400,000 of them signed those petitions from California. So it's not merchants against bankers, it is individuals like us. I have one store that I depend on the income from to support my family. And like Mr. Barsi had said, that what I can do is cut down. Instead of working 8 hours, I work 12 hours. That's the choice I can make. But with the interchange fees, I don't know what those fees are. I don't know how much they account for. And the other thing is, like the member, Mr. Nilo said that, well, you don't have to accept credit card. Well, I think right now it's like saying I don't accept US dollars. If you say you don't accept credit card, it will be similar to saying I don't accept US dollars. It is a form of currency. Europe is moving to a cashless society, and we are getting close. We are not that far behind. So it is a form of payment. If I'm a retail merchant and I say I don't accept payments, how am I going to sell my goods and services? I would like to thank you for listening to me. Thanks.
My name is Ashok Kumar, and me and my wife, sitting in the audience, we own 2 7-Eleven stores in Fremont. We drove here with enthusiasm and in support of all the franchisees, and especially the sentiments that have been expressed. I'd like to ask of the remaining members of the committee to show their hands if they've ever owned a small business.
Well, I didn't get credit cards.
And one more question. Okay, that's 2 out of 4. That's not
it was
bad.
Office.
Okay. And have any one of you ever shopped in 7-Eleven store?
Oh, yes.
Yeah, you know, I mean, Dave mentioned.
I buy gum and I get $40.
Well, with that, I don't have anything to say. Thank you. Thank you for understanding our problem. Now, honestly, I think what bothers me is that we have a ROP center right across from our store, and we would love to have those kids, and we used to do that, have those kids come and train. We work with their marketing department. We do local, give them little flyers to design, and they would go around and distribute in the neighborhood. So this was a way for us to interact with the community. We donate, stuff to school, etc. And we were just about working, last year we were working with an internship program for the ROP so that they can actually come and get trained. So before they would finish the ROP session, that they would have some experience under their belt, and we were going to pay them. And it became so hard when all of a sudden we started seeing this. It was 2008 onwards when 7-Eleven started passing half of the burden of the interchange fee to the store owners. Mm-hmm. And our bill came to like $800-900 a month. I mean, and this was like 4 or 5 times the budget. We were thinking about getting involved with the local community and kids, and that took away that great opportunity. I mean, we all understand, we all appreciate that, yes, this is a valuable service. Credit cards are here to stay. But the more I got involved in the process of figuring these things out, what I realized, and I think most of us have expressed that sentiment, that A, we really don't clearly know how much money to budget for this, except that, one day we're going to find out, oh my God, the usage has gone up, so I better go do something about it. And second, there is no way I can sit down with anybody and negotiate. It's like, I might as well go in a bomb shelter because I don't know what the next one is going to be, how big that is going to be. Mm-hmm. So I think I'm not sure that this has to be brought to a legal issue, but I think you also have the second effect or the power to exert influence, maybe through the Senate and through other avenues where we can bring this to a discussion on the table. And I think we really need to move this in the direction of transparency and more negotiation.
Mm-hmm. Yes.
I have a question. In the 7-Eleven stores, your franchisees, who sets the prices for what you sell?
As an independent operator, I'm free to set the prices. Okay. But generally, we don't want one 7-Eleven store and the second one having a different price structure, so we just follow the guideline unless it's something that is of very local interest and only our store would carry that product, and that's when we get into different pricing structures.
If you follow the guidelines, that means that 7-Eleven
has done the price.
The corporate offices actually will end up setting the prices.
They recommend the prices, and we most of the time follow that. Donut is 89 cents. Doesn't matter which 7-Eleven store you go to.
They recommend.
Yeah, in a way, that's a problem in and of itself.
Tell me about it.
So I mean, because if you there's this complex issue.
It is a complex issue.
And that because Safeway, for example, doesn't have franchise stores, as I understand.
Correct.
But when you have franchise stores and the corporate offices are setting the prices,
and they are the ones who are negotiating the contract with the credit card companies.
Right, then you are then there's that's an issue in and of itself. Okay.
Okay. No, I think, but together as a team, with the brunt of this inability to negotiate and lack of transparency, I think we both, 7-Eleven Corporation and the franchisee, are facing it together.
Well, they're passing down more cost to you, but they're not allowing you to. There's a pressure against allowing you to change prices. That's an interesting dilemma.
Can I answer
in a way, it's sort of I guess it's an interesting item because in one way it raises thoughts about price fixing, which they get around by saying that they are one organization, and so they're not really price fixing. But you are the actual operator, and so it's treading a thin line on certain on a variety of issues.
Yeah. Well, what they have done is, like, they do recommended pricing, and it's up to us whether we want to follow it. What they have done is they have done the research, what the market is doing. As everybody has commented, it is a very competitive industry. So what they do is they show us what the competition is doing, so it's up to us. And I believe that none of us has 100% pricing what 7-Eleven recommended. We take it and then we tweak it and use it to compete with our competitors locally. So it's, again, it is, all they provide us is the research, and then it's up to us whether we want to spend the time and do some more research, or we just take it at face value and implement that. I don't know whether I'm able to explain it.
We do have systems in the back office where we go, and each price we have to accept the price or we have to change the price. So they do provide an option. But that would require us to hire more people to really be, take use of that facility. And then we're back to where is the expense? Where can I cut? Where can I save? And where can I go with this? And this comes up as the second largest expense in our bottom line.
If you would, please. Thank you.
Yeah, my name is Gurtar Sandhu. I'm from Carson, California. I'm also 7-Eleven franchisee. I'm just here to back my fellow franchisee, Navdeep Basi, and Mr. Dave, and the rest of us. I just want to let you know, Mr. Chair, that small business is the backbone of America.
Mm-hmm.
I grew up in this system, and at this time, we need your help. It is not that we don't want to interface fees. It is the fairness of it. When I have only 2 banks or 6 banks, I have no ability to negotiate. If that's not a monopoly, like Mr. Dave said, what it is. I think that is what we are trying to bring the attention to. Not to say we don't want the fees, we understand it's the cost of doing business. We understand that. It's the fact that we can't negotiate or control it. That is why we are here and ask for sure.
Mm-hmm.
So I want to say thank you. Thank you for your support, and we look forward to it.
You're welcome. Are there others who wish to offer public comment?
Thank you.
Thank you. Let me just say in summary, I think for all of us this has been very, very instructive. And for the franchisees and those entrepreneurs, I have a great deal of admiration for the courage that you show to assume the sort of risk that you do, to invest the kind of money and your time and your commitment in your stores, in your communities. You create employment opportunities for people. You donate in the communities where you live. And I've got a feeling that they're not always in the easiest neighborhoods to do business. They are, in fact, in challenging parts of a city. And in many neighborhoods, your stores are the only places that are within walking distance or close by, where families can get diapers and formula, food, light bulbs, extension cords, the kinds of things that people find that they need. And oftentimes, where you're located, the larger commercial enterprises, the big stores, they're nowhere to be seen. And you fulfill a very, very important need. And part of what you are confronted with is attempting to manage that business, attempting to calculate your payroll, trying to meet the cost for insurance, utilities, all of what goes into running a small business. And I'm really struck by the fact that for a minority community, this really becomes access to development and growth and prosperity and success for yourself and for your families. And I was impressed by the fact that there isn't one of you who said, I don't want to pay these fees. There wasn't anybody who said, do away with these fees. We can be more successful. I want more money in my own pocket. What I heard each and every one of you say, and it makes perfect sense given the country in which we live, why don't I understand how these fees are calculated? Why is it that I feel as though I don't have a seat at the table when I negotiate, when these fees are negotiated? When you know that there are people involved in your industry who negotiate for the price of bananas and light bulbs and everything else that you sell. And so you are drawn to a capitalist American model that calls for participation among equals in what you buy and what you sell and how you operate your business, except for this one aspect of your business enterprise that by any measure, even testimony from the industry, seems to me to be closed off. It is as opaque as it could be. When I hear from Mr. Bernard, the manner in which the statements are provided at the end of the month, and the amounts are broken out, but he lacks the ability to isolate any single transaction and say, the fee for that book I sold for that card was 17 cents, 18 cents, 47 cents. That's a tremendous, in my opinion, shortcoming. Because you ought to be able, as business owners and entrepreneurs, to calculate what that means in terms of your business operation. Do the interchange fees also provide opportunities? Well, we heard from the community banks and the credit unions that in their particular industries, it provides an extra measure of service that helps them be competitive with other financial sort of entities. And so there's a reason why there's parts of the industry that support the interchange fees. But I still have yet to get an answer to the question of why is it that these fees for different industries are not transparent and available and accessible. And the argument that there are benefits for the fees so that if you're selling a large piece of furniture, the vendor is not left worried about the payment because the payment transaction is automatic, that doesn't apply in a movie theater setting. It doesn't apply in a bookstore where the average sale is going to be $25. So the kinds of risks that are protected by the interchange fee exchange doesn't really help that particular industry. But there's no indication that the fees that they have to pay factor in that there's no risk of loss for that kind of business. And so I think, quite frankly, I think that what we heard here today was very balanced. And the anecdotes that people provided are going to give us a great deal of information and familiarity with the franchisees and how they operate their businesses, and movie theaters, and large businesses, and community banks and credit unions, and why all of this is of value. It does have some value. But I do think the notion that ask your credit card holders, if they're happy with their credit cards, I don't think that's going to work. Because I think, quite frankly, there's a significant level of dissatisfaction with fees that are paid for credit cards. There are people who are unhappy when they learn that there has been a relationship between a failure to pay or a late pay on one card and then an increase in fees on all of the cards that you hold. Don't tell me people like that. People don't like that. People don't like when the interest rates are suddenly accelerated because of some sort of an incident, and you go from a relatively low rate to a high rate, and you don't understand it. People don't like that the industry over time has changed the payment period, your grace period, where it used to be 30 days. It's not 30 days. They can change that whenever they decide that they want to change it. And so I think there's a fairly high level of dissatisfaction with the credit card industry and how they operate. But I think for the members of the committee, and quite frankly, I have to tell you, for most of this committee hearing, you had practically everyone here at some time or another. That doesn't happen very often with informational hearings. And I think it is because the members of this committee take this issue very seriously. And there isn't one of us here that doesn't want to see some measure of improvement that will be of benefit to small business owners. The small business owners are indeed the backbone of economic growth in this country. It's not the large corporations. It is those of you who hire 4 or 5 people at a time. You know who the people are that you hire. You are familiar with their families. You know when their birthdays are. There is a certain intimacy in the nature of your business that is very profound, and that is, quite frankly, the reason why America is the kind of country that it is. And so it's been an honor for me, and speaking on behalf of the other committee members, to have all of you here today. That you would come from Fremont and from Carson and from other communities. That some people came from Washington? No, Washington. Some people came from Washington. Some people came from Murrieta. But people came from all over the country just to spend a little time with me. Didn't have anything to do with me. People came from all over the country because this is a serious issue, and consumers are concerned when they really don't understand what it is they're paying for and how it's being calculated. So I want to thank you for being here. You have done us a great honor by taking your time and offering testimony. Thank you.